Welcome to Invest Austria, the flagship event for private capital investors. My name is Laura, and I'm the Managing Director of the Austrian Angel Investors Association.
A very warm welcome also from my side. My name is Arno Beers. I'm the Managing Director of AVCO. And together with Laura today, we'll guide you through the conference. Let's first welcome Nina Wöss, Chairwoman of AVCO, and Niki Futa, President of aaia, on stage for welcoming words.
Thank you, Laura and Arno. Very warm welcome from my side. My name is Niki Futa. I'm the President of the Austrian Angel Investors Association. And we are happy to have you here today in a collaboration of AVCO and aaia to bring the best of early and late stage investment to your audience today. Nina.
Yeah, we are keeping it short and simple. I can only join in this very warm welcome. Thank you for joining in today. It's all about collaboration and also sharing best practices and experiences. As we'll see throughout the day today, there are a lot of challenges ahead, and it's hopefully a joint effort in facing them and solving them. And with that, handing it back to Laura and Arno.
Thank you.
Yeah, thank you, Nina and Niki, for being our hosts today. So why Invest Austria and why are we all here today? Investments in innovation are essential if we want to create the leading companies of tomorrow, and also if we want to find solutions for the challenges we are facing today. But at the moment, there is just not enough private funding in Austria and in general in Europe. So we need to start investing in innovation on a really large scale to strengthen our economy, to create jobs, and also to stay a top player. So this is exactly the reason why we are all here today. This topic is so important that only collaboration can make a change. This is also why AVCO and aaia joined forces for this event. And it's not just us in the room. We have a live stream until lunch break. You can see the cameras behind you. And please also spread the word about that event on social media.
Yes, Laura, I can only agree. We indeed are very happy to join forces. But by that, I'm not only referring to the collaboration between aaia and AVCO. I also mean the type of collaboration enabling the continuity between early stage and later stage. The type of collaboration generating the dialogue between public and private entities, which is a precondition of the improvement of the investment framework in Austria. I mean also the collaboration between Austrian and Central and Eastern European investors. Well, in fact, I mean all types of collaborations we intend to spark today while organizing Invest Austria. And of course, we expect all of you to be part in it. And to start with, I would like to pass over the torch to Ingo Bleier, Chief Corporate and Markets Officer at Erste Group. But I would like first to extend a big thank you to Erste Group for being a valued and trusted partner of Invest Austria for the second year. And of course, a big thank you to all other partners who are supporting this event today. Ingo, the floor is yours.
Right. Good morning, ladies and gentlemen. And hello also to everybody on screen today. I'm sure if you would all be here, we would fill this hall easily. We have had the conference until now at a different place, so we still need to get used to the rather, walls and the floors which produce maybe an echo. If I'm too loud, please give me a signal. Yeah? We're all very happy to be here, obviously. And to take part in this very important conference. Why does Erste Group put its flag here? It is because equity, subordinated capital, everything that provides resilience to the corporate sector is very important. And probably it's more important now than it was ever before. At those conferences, we usually praise the startups, the growing companies, the smart investors, and then we also complain a lot about the legal framework, the tax framework, and I can tell you we really have a weak framework currently in Austria when it comes to the structure of the venture capital and private equity industry. But now I think we are in a more peculiar situation, and we need to look a little bit beyond those usual, day-to-day business that we are doing and the usual lobbying efforts we are doing. We're in a situation now where I think we are in front of an almost certain downturn. Markets are typically anticipating this very well. And if you see what the public markets have been doing this year, here's just two very important indices. You will feel what is probably ahead of us. Yeah, we're more than 20% down since the start of this year. And guess what this does to valuations in all the large funds that are trading in the important indices? They will see their allocations to alternative markets, to private equity, having climbed in percentages, right? So this will make fundraising exercises probably more difficult going forward because the public markets are going down pretty fast in their valuations. The liquid market, there's a time delay, it takes longer. So that is certainly difficult news for us. And both the issuers and the investors will need to adjust to this reality that we have now in front of us. Also, in the context of this development, debt instruments are becoming more expensive now. Debt structures are becoming more conservative at this moment. So we are in for quite an adjustment. And I have to say, we have seen some of Americans have called it exuberance before, in terms of company valuations, in terms of debt structures, and this probably needs to normalize beyond the usual extent now. And this may be the reason why people like the economists are saying we're probably heading for a fall. Yeah? So don't take it too serious. Normally you expect at the start of a conference, a lot of very positive news. I have to start with some realism. Yeah? Some of you may have seen this article. We have really been going up very well, and now there is a problem. But the good news is there is massive capital. Massive capital. We are speaking globally of around $1.2 trillion in so-called dry powder at the moment. A significant amount of this is available here in Europe, and there is no shortage of willing investors. Believe me, no shortage. Including us, including many funds, including capital providers all across Europe and the globe. But in order to access capital, I think we need to move, again, to more rational levels in a lot of the transactions we are doing. I think what is very important at this point is really strong corporate leadership. We need to be able to mobilize the capital that is around. We need to be able to get to scenarios where investors, issuers are meeting at realistic levels. Some of you may have read Burton Malkill's book, A Random Walk Down Wall Street, and you may have read through the various valuation theories. And those of you who recall the so-called castle in the air theory may be alluding to what we have seen recently. So I think this adjustment process that is now happening with the market situation can be quite severe, but it does not mean that there is no deal flow. On the contrary. We and many others are very willing to do deals. We are very willing to act. And we're in a situation where, with the circumstances around us, the private sector has an enormous responsibility. We are looking regularly to the public sector, we look to the governments, we expect the governments to solve all the problems. We have over the years now come to a situation where many people would think that if there's an issue somewhere, let's throw money at it and we'll solve it somehow. The state balance sheets, the fiscal situation will not be able to carry all the load. The private sector needs to show resilience, corporate managers, investors need to act in a very smart way, adjusting quickly to new realities, show flexibilities, and be able to continue with proper business. We at Erste are certainly willing to do that. We are maintaining our commitment to private equity and venture capital as an investor, as a fund arranger, and as a distributor of funds. We'll uphold this commitment through the cycle, and we hope that there's a lot of others joining us in this effort in ensuring that the market does not depend only on certain political actions, framework actions, or the new valuation realities. With that, I would wish you a very pleasant conference. I hope it's productive. And think of this, very often pictures remain better than graphs, and you deal with a lot of graphs in your, in your daily business. Flexibility and adjustment. I think those will be the key words that will be with us for the next, 1 or 2 years at least. All the best. Thank you very much. Have a good conference. I hope this was fast enough.
Was perfect on time. Thank you, Ingo, for being a trusted partner and for supporting us since many years.
Sure.
So now we're getting ready for a CEO of a company, a successful scale-up actually, which was founded in the Czech Republic. And this scale-up had made our lives a little easier in the past years. And I'm happy to welcome Maurice Breuskens from AVCO Austria on stage for our first keynote of the day. Welcome.
Servus and good morning. My name is Maurice Breuskens and I'm CEO for AVCO.at, an online supermarket. And most of you read newspapers and are wondering, again a supermarket, again this quick commerce, again quicker delivery, again not profitable. But that's not the case. What we do is very, very, very different. We focus on weekly shopping, meaning we are looking at an AOV, an average order value between 90 and 100 euros. We started looking at Austria in Q3 of 2019, 6 months prior to COVID. We then said, okay, this is an interesting market. It has tremendous potential for our concept, but at every corner of the street, there's also a traditional brick and mortar supermarket. So we need to be very, very different. We have to focus on service. We have to find our way to make this work. So along our journey, we took very conscious steps and decisions to get that to grow. And yes, we have made tremendous progress, but at the same time, we are at the start of our journey. So how do we look today? We started with the first deliveries in the first week of December 2020. I founded the company here, did the registration in July 2020, 3 months after officially COVID arrived here, building up a virtual team, getting a warehouse in place, doing all the registrations and all the stuff, and then I needed assortment, I needed suppliers, I needed to put all the infrastructure in place in a very short amount of time, because who knew how long this is going to last, and we want definitely to ride this wave and benefit from this. So year one, we did 50 million euro revenue. We are, in the meantime, almost 1,800 employees, from which a big part works, of course, in our fulfillment center. But at the same time, our drivers are the heart of the organization. They are the main point of contact to deliver these goods to the customer. Therefore, they are directly employed by us. They are trained for 2 weeks, and then we actually send them out. We have, in the meantime, actually last week, we delivered the first 1 million order. Yeah, so since the launch date, we have currently a database of around 110,000 active customers here in Vienna. We have more than 550 direct suppliers, and this makes us very different. Why? Because we basically shorten the supply chain. We are in the heart, we are a tech company. We do everything data-driven. And there is one policy we live by. We don't send emails. We only send emails to customers, but internal emails are forbidden. So I don't look at my email, I look at data. I look at what customers tell us. And that led actually to rapid growth. But what is very interesting at the same time, we were actually forgotten when we looked at this journey. When Statistica looked at the market in 2020, they thought, okay, the market is only 149, and this is going to grow until 200+ million in 2025. In 2020 alone, I did 7. In 21, I did almost 50. And this year, we're going to double again our revenue. And we did not stop growing yet. We are only at the beginning of this journey. So they actually forgot, where is this journey going to go? And what does this space actually kind of need in order to drive going forward? So how do we do that and where do we want to go? Here in the gray part at the bottom, you see classical brick and mortar concept. You go to the supermarket, you pick up your items, and you're the lucky one on Saturday morning to at least queue up for 20 minutes, a given. Yeah? You could be a bit more techy. You could say, I order it online, and I go to the shop to pick it up. So those two things we definitely do not do. Yes, we announced it during the 1st of April. Yeah, that we would open brick and mortar. I never got so many emails, yeah. But the reality is brick and mortar is not our concept. We go to the customer, we deliver this service. So what we do is we offer a very wide portfolio of assortment. So we have currently around 13,000 SKUs in the assortment, food as well as pharmacy products that we deliver. Customers order them via the app or via the web shop. And we then deliver to them when we actually can. This is within 3 hours after your order comes in. This is from Monday to Saturday, yeah, from early morning to late. But it still depends in step 1 on our delivery capacities. And building a business that rapid in COVID and having COVID even among the direct workforce was definitely not the easiest. We are currently at the second step. So I buy my groceries online, a courier brings them to me when I exactly want them. So we have 15-minute slots. So when everybody's jumping from one Zoom meeting to another, you put a blocker in between of 50 minutes, that's exactly when we can deliver. That's great, but we need to do more. We need to basically tell to the customer, this is what you actually need. And that's our next step. So the next step will be making assortment proposals saying, be aware, you have ordered this in the past, you're gonna need that. Another step is then to say, okay, people are slowly moving back to the office. Why do you need to actually be at home? I can put it for you in the fridge. That sounds like science fiction for many people, but that's what we're going to test. And I was initially a bit skeptical because people say, Austria, you have to be a bit slowly, it's a bit more conservative, it takes time. No, we had in no time 2,000 customers that said, we want to be part of the test. Yeah, I will not be at home, but please put it in the fridge. So this is the next step for us. And then, of course, the last step would be, you don't have to do anything. You know, or we would know, what you need. When your fridge is empty or your pantry is empty, we fill it up for you. And that is data, 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 data. Yeah? And that's what drives us, and that's what basically helped us to get to scale fairly quickly. So how do we do that? We put traditional thinking of a supermarket completely upside down. So if you're a producer and you want to have your product in a supermarket, you normally pay these listing fees, ranging from 10 to 20,000 euros. I don't have these. You have a great product, you come to me, I guarantee you, I test it for 6 weeks. If it's selling, I keep it. If not, I kick it out. Very straightforward. Yeah? What we also do is we say, we want to support smaller farmers, smaller producers, these items that are hard to find, which are costing you a lot of time to drive. I'm a father of 2, I love shopping, I've been my entire life in food, but I would have spent at least 3 hours per week picking up my wines, picking up the bread, picking up my fruit and veg. Unnecessary. We have put this all together, and I work with great companies. One of them, for example, AVCO Bakery, a company that I was part of and that I still support today. We brought actually their bakery inside our fulfillment center. Your bread on Saturday morning is still warm. It's possible. It's possible to deliver that service, but it's only possible if it makes financially sense to do so. And therefore, we focus on this weekly shopping. We focus on the service and we focus on this weekly shopping because only then it pays off. And we do this with some great companies. As you can see here, we have some of them exclusive, like a Marks & Spencer, for example, which we have brought in where we say, actually, there is an interest for these products also in the Austrian market. So how do we actually do that? We monitor analyze data in real time. So where we see every day an article is selling more, it needs more space in my fulfillment center, I put it an additional time in a push notification in a newsletter, but it could also be the opposite, where we see actually this article is not working very well, we actually have to reduce it. Yeah, maybe it's not selling, let's figure this out. So we have fulfillment center, we look at our processes, and we constantly optimize our supply chain. And the supply chain is actually optimized in a way that we even support smaller companies, smaller farmers, so that we can pick this up from them, so that the producer can focus on production. We help them with production plans, so that they don't need to overproduce. We reduce food waste, great, yeah. We have very simple service level agreements in place. We support them with marketing, but the biggest lever there is actually the logistics and the marketing support that we are able to bring to smaller producers. If I look at Michi Bauer, for example, in Rust, which is an hour, a bit more than an hour drive from here, he can focus on his production. We bring fruit and veg in season in 7 hours from harvest to customer table. That is planning, 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 and constantly collecting feedback. Here a bit our journey from the last couple of months, where we focused, yes, also with the group slowly on private label. Private label, of course, being crucial, on one hand, driving margin up. Other hand, we see, of course, in times of crisis, people down trading slowly. Then you need to have private label in place to have these alternatives. We actually changed our fulfillment center processes to a 3-touch, so that we reduce the amount of labor that we actually need. We have 15-minute slots, price guarantees for a key basket of items until Easter 2023, so that customers have a peace of mind. Yes, I know all the prices across Austria. I know this live. We constantly check this so that the overall basket is exactly the same price. But people want stability, and we managed to put that in place in a very short period of time together with our partners. What we did as well, we have the largest plant-based shop online in Austria. I believe what is crucial here, again, working with smaller producers, working with smaller companies, and understanding what we basically need to do in order to offer a wide assortment to the right people, again, optimizing food waste on one hand, but also taking care of sustainability and driving the business together with our customers in such a way that it makes sense. So a normal supermarket drives basically assortment from a category manager. The category manager gets in contact with the producer or the other way around, they list the item, it's done. In our case, customers go online, go to the app, go to the website, say, you are missing this product, can you please list this for us? Goes to the category manager, all without email, yeah, and then he basically focuses on the listing. And this is actually how we have built this category. Apologize here for the crazy colors, but we have more than 2,800 products. We have exclusive collaborations, and what we actually did, we offered for milk alternatives lower taxes, because the price, the tax that we have on normal milk and milk alternatives in Austria is still not the same. So we basically, let's take that initiative and drive that forward. What is for us very much the next step is looking at automation. So here on the left side, you actually see the current fulfillment center that we have. We're gonna extend that with 5,000 square meter, bringing the total size to more than 10,000 square meter in size. We will be ready by 2023 in Q3, and then we're gonna work with the AutoStore technology, because otherwise I would end up in a situation where I no longer can find the labor. Very often I have the question, Maurice, what would you need to grow even faster? Well, I said, I actually need cars. I cannot get cars. I get cars from all over Europe. Why? Because we currently drive with electro, hard to find, then how to charge them, infrastructure not so easy, yeah. So this makes it definitely more complex. But the second one is, of course, employees. Yeah, how do we find them and how can we basically educate them, grow with them, and that would mean that I need to again double in size, which of course is a challenge. So we looked at different technologies, decided for the AutoStore technology, and we are looking forward to get that implemented. What makes us different is passion. Everybody that works with us is driven and obsessed by food. We take data-driven decisions. We are open and very transparent about communication. That means I send out a newsletter once a month directly to our customers, and I have interactions with customers. Yeah? We go for speed kills perfection. Perfection in a startup doesn't sit well, so we need definitely to move quick, and therefore we also have this open failure culture. You're allowed to make mistakes because the speed is definitely at the essence. Yeah? And last but not least, you need this entrepreneurial mindset. If you have an idea, go and make this happen. And I think in Austria, and also having 42 nationalities in my team at the moment, yeah, we definitely have this bright and broad platform actually to make that happen. So here a couple of customer feedbacks. I think we're definitely on the right track. We definitely got recognized by our community, and we are constantly building. And next week I have another platform where our top 10 customers basically come to our office, we do a tour, and we then are talking with them about next features and things to come. So we are at the early journey. It seems always from the outside, wow, that's easy, you were at the right time, you had COVID, you rode the wave. Yes, get that. But building up a company this size, so many employees, I had weeks where we were hiring more than 150 people. Then working with all the regulations and setup in Austria was not always easy. Definitely not. I mean, setting up a GmbH in Austria took me 2 months. In Holland, where I'm coming from, as you hear, would take me 24 hours. Yeah? So it is not always that easy. But if you go and you reach out to the people in the network, you get tons of support. Because Austria is a great place. I truly believe that we have made tremendous progress also when it comes down to IT. In terms of tech, we are at the early stage still. But we're making tremendous progress, and we do that by working very closely together. Thank you very much.
Thank you well, Maurice. Thank you for sharing this fantastic story of Google and sending the first knot of optimism in the day. Now let's move to panel 1. Disrupting is not the only recipe for success in times of crisis. And we will therefore now explore alternative strategies with Nina Vos, together with her first panel in the morning, Milen Ivanov, managing partner at Austrian Angel Investors, Alexandra Laska, partner at Rail Alpine, Stephen Pauls, founder and CEO of Moonfair, and Elena Torras, Hanswoman.
So, thank you everyone for joining us on stage and for joining me in this conversation. Logistics, your mics are here, there is water. If you need anything else, please let me know, because the team is for sure happy to help us. And in order to get us started here, and to make sure that the audience is also familiar with the people that are going to be involved in this conversation now, I would ask you, starting with Steffen, to introduce yourself quickly, to mention what stage you are investing in and what type of investments you are doing in your daily business, because that's what we will be discussing for the next 45 minutes. Please.
Yeah, wonderful, and thanks first of all for having us today. So my name is Steffen Pauwitz. I'm the founder and CEO of Moonfair, and what Moonfair does is pretty simple. It opens up private equity, venture capital, growth capital to private individuals. So to your question, we are opening up various asset classes, investing across all cycles and strategies. And in Austria, you can access the platform and can start investing with as little as 50,000 euros.
Thank you.
So thank you very much for inviting me. I'm Elena Torras, I'm from Spain, and I've been an entrepreneur, and now I'm investing for Hansi Hansman, for Hans Women Group, in the South Europe.
Good morning, my name is Alex. I'm a partner at Red Alpine, which is a venture capital fund based out of Zurich, and we invest in tech startups at seed and Series A stage. We've been around for 16 years, which is a bit of a dinosaur in European terms, and I'm looking forward to this discussion.
Thank you.
My name is Milan Ivanov. I'm managing partner at Austrian Angel Investors. We are a co-investment fund that invests alongside angels, family offices, corporates, and private VCs. We have a mandate by EIF for 5 years to invest this 13 million and match private capital investments. Our stages pre-seed and seed level, we invest from 200 to 500K in scalable technologies companies, not only from Southeast Europe, but also throughout all EU.
Thank you. And to make sure that also the panel has an idea about who is in the room, I would ask for a show of hands who is actively investing in Europe, regardless what type of investments you are doing. Okay, very nice. Thank you for sharing that, because that also helps us in sharing our learnings and best practices. So looking back basically at the last 2 years, or probably 10 years, we look back at the time of boom, of exits, of new unicorns entering the European tech arena, of raising mega rounds that were almost a little bit scary looking at from the sidelines. And yeah, this level of scariness is hitting us now, as we also see in the numbers that have been published recently about the European funding landscape, where we look at a drop of 44% of VC and PE money that has been invested in Europe in Q3 of this year. In comparison to last year. So what does this mean? And what does this mean in like numbers for specific regions and stages? And in order to put this also into perspective and make sure it's not only doom and gloom we are looking at and discussing today, I have asked our panelists to bring along some numbers themselves, as we investors always love looking at numbers and putting them into perspective for their respective stage. And with this, I would actually start with Steffen again, as he's basically coming from the LP side, and there are quite a lot of GPs also in the room today. So Steffen, when you look at investment activity of big fund of funds and institutions investing then in PE and VC funds, what are the recent trends that you and your team are seeing, and are there already some implications that you would want to share with the crowd today?
Yeah, look, happy to. I think we have to differentiate between 4 different buckets, call it. One is, of course, what happens on the portfolio side. And there a lot of challenges are ahead of the industry. Then we talked about fundraising, and I will come back to this in a sec. Then, of course, what does it mean and what is the impact in terms of investing? And then what is the exit, how are the exit markets look like? If I may talk about fundraising, we saw this from Ingo in the keynote in the beginning. The GPs are still sitting on piles of cash. And fundraising environment is more challenging. I would call it, it's more differentiated for most of the GPs. But if you see, for instance, in the buyout segment, if you take latest fundraisings, EQT, for instance, largest fund ever, first close 15 billion, CDNR and others. So fundraising is still astonishingly, and I'll come back to this in a sec, intact. But it takes longer. And why is it intact? And that's important to understand. People have learned from the past. And this is one point that makes me very positive about this crisis, because most of the managers and also LPs that are still in charge today have seen financial crisis and have learned out of the mistakes made. Post-financial crisis, if I may state this for a sec, and I've been with KKR in these days, the industry basically stopped investing. It was like in a shock. And the only one, or only ones that are, at least in the buyout segment, if I may take this example, that were actively investing, were Blackstone and Apollo. And there's a very interesting phenomenon. At post-financial crisis, 2008-9, KKR, Apollo, and Blackstone were more or less on the same level. Blackstone went long, Apollo did the same, by the way, and today there is a huge gap in terms of assets under management and success also between those two. So the industry has learned, That means when we talk to GPs as an LP, we see they are in very, very positive mood. We see the contractions finally in valuations, not yet there. This is why currently the investing activity has slowed down. But looking forward for the next year, the industry is very, very positive. And we all know from past data, if there's a time to invest in venture growth and private equity, it's now. The best vintages we've seen, 08, 09. Best vintage we have seen post 9/11, 96. So the current recession offers a huge opportunity for the GPs, and smart LPs know this and go long.
That's very good news indeed. So looking at the GPs and active investors that are also now on stage with me, starting with you, Alexandra, how is your experience also in deploying money and in the recent activities that you've seen, especially in the deal-making process nowadays?
So firstly, I think that it's very difficult to do a year-on-year comparison because, as you mentioned, the last years have been pretty extraordinary. And in fact, I call this normalization rather than a complete drop in the market. And I think the last years have not been sustainable, to be honest. And I'm actually quite positive about what's to come because I think we will see better deal flow, higher caliber. We already see it now. Summer season was a bit quiet, as usually is. But September onwards, we've seen a huge inflow of very interesting, strong teams. On the early stage side, of course, because this is our focus. The drop in investment was predominantly in the growth or later stage. So on the early stage, we still see very compelling for founders valuations and round sizes. And I think that VC funds going forward will probably focus more opportunistically on downside protection and better terms. But I'm very positive that the early stage deals will continue to go strong. I do agree that VC funds will become more picky. There is a flight to quality. I think there is a huge interest or focus on route to profitability rather than growth at any cost, extending runways for existing portfolio companies. But as you mentioned as well, during the last crisis, 2008 financial crisis, the likes of Airbnb and WhatsApp were founded. Cisco got their initial seed ticket a few weeks after the Black Monday. So I do actually believe that this is a very exciting time for VCs to invest in sustainable business models with a very significant tech hedge and product differentiation. I think these are the key things we've been doing for the last 16 years, but I think more than ever before, this is a very important aspect to look at when you consider an investment.
Thank you. So, Milan, what do you see in your daily business in your region?
Yeah, I know this is a panel for crisis, so I try to be more positive here because for Southeast Europe, the first half of this year has been record high in terms of venture capital investing. It's close to 2 billion. And in terms of enterprise value increase, it's like 5 or 6 times, which is much, much better than the average of Europe, which is 3.3. And of course, it's starting from a lower base, but still there is a lot of opportunity to grow just because the market is emerging with these aspects. So there is this data that the venture capital investments in this region are only 20 euro per capita compared to 115 in DACH region, and in the Baltics they have tremendous numbers like 200,000. 200 per capita, which means there's a lot of room to grow. Of course, people are a bit gloomy with the situation because the inflation is very high. It's close to 20% on average. In my country, in Bulgaria, it's around 13%, but everybody knows that it's much more. And people have kind of forgotten about COVID, and now they're worried about the war in Ukraine and the rise in energy prices. But the recession is still not quite there. We kind of know that it will kick in. Winter is coming, and then the consumers will feel it, and maybe the businesses that are oriented with this aspect will feel it too. But the investors are kind of okay. Slow down. They decrease the tickets, but they're still investing in early stage because there's a lot of capital from before. There are some government funds that have been backed up by EF and the national governments that have mandates. They have to invest the money, and they were driving the valuations like crazy. And now what's happening? They're sobering up, which is good for those that are careful with valuations like us. And yeah, we're positive in terms of opportunities. Of course, we are worried of what can happen because we are very close to the war, and we feel it physically, not like only on TV.
Yeah, that's definitely an important aspect to look at, and something that we also see reflected in the inquiries we receive in our daily business from working with startups from all over Europe. So also then handing over to you, Helena, as you're usually among the first investors. If we look at startups, what are the questions that you are facing nowadays as a very early stage investor, and what are also the highlights and lowlights that you might have encountered in the past weeks and months?
Yeah, so thank you. I would repeat everything that my colleagues have said because I couldn't agree more. But it's true, we are very positive. Now there is a massive deal flow, really, more than ever. I will talk about Spain. We are already on the second-time entrepreneurs who are launching startups. So I would not say we are mature yet, but we are on the process to do it. Last year, we raised in funding rounds more than 4,000 millions versus 2020, which was 1,000 million. And so far this year, just in the first semester, we have done more than 2,000 million. So there is movement, and when you are there, you want to stop it even if there's a crisis, because when there's a crisis, there is even more deal flow. There are even more projects starting. There are even more entrepreneurs wanting to launch new ideas, and that's the best moment. So there is really, really massive deal flow, but so when we talk about Spain, even before winter had come, we already had smaller tickets. When we are talking about valuations, valuations are decreasing. Valuations are decreasing because the tickets are decreasing. It's not because, in fact, the value of the company, but because we are investing less money. So when we are talking about Spain, our pre-seed or our seed stage is quite different of what your pre-seed or seed stage mean. So usually it's a zero less than yours, so we were small. And now, we have so much opportunities because it's, I don't like the word cheap, but it's cheap to invest there. You can go in really amazing startups that will be really capital efficient because they know they will not get funding, and especially when you are investing in these startups, you are telling, if with the money we will give you, you have to be 18 to 24 months with that. Maybe you need the money before because we want to go big, because we want you to go faster. That will be, but if not, you have to be sustainable. And I think that's the difference. Maybe before we were, okay, if you need money in 1 year, we wanted a profitable business, but it's okay. And also the question is, for what will you need the money? So for this growth, what will this mean? Is for marketing, so it's a business that only will grow if you invest in marketing, or the money we will put for growth is for expansion, is for going to other countries, but it's not only marketing based. And I think this really is a huge difference because it's changing also the kind of projects you are financing.
Yeah, that actually ties into my next question that I would address to the investors who are directly investing into the targets here on stage. Basically, the implications on the one hand for your day-to-day portfolio work that you're seeing, because also like basically at the target level, we are seeing rising salaries, which are just necessary to reflect inflation and rising energy prices and so forth. So there is actually, on the one hand, most likely a higher burn rate versus maybe spending less on marketing, etc. But on your board work especially, and on your day-to-day interactions with the founding teams you are working with, what did change? Because my impression from talking to investors is that there have been quite some, I would say, strategy meetings to also adapt your operational work. Is there insights that you can share also with the group? And maybe also for the discussions then in the coffee break, because I would be surprised to hear that everything is just as it always has been, has it? who would like to take
Okay, happy to jump in. When the crisis really started, you know, the first thing we got on our table from the Sequoias, from the Kleiner Perkins, were decks for their portfolio companies saying, if you don't adapt to the new reality, you will not survive. So there is no more of the same, and let's continue as is. What you have to do is, in stating the obvious, you have to, of course, optimize for cash. It's a zero-based budgeting approach, really asking yourself, is this absolutely needed? The second, what you need, and we are seeing, by the way, already quite a few layoffs, and there's more to come as people prepare. The second thing, what you have to make sure, and that was already stated here on the panel, is make sure that your runway is sufficient. Because in the current environment, people would face down rounds, or they would be facing, you know, liquidity preference or structured notes. And with all means, you have to avoid this. And when we talk about run rate, it's not about 12 months, 18 months. The advice from the largest investors, tech investors in the world, is you should prepare more for 36, 48 months. If you can still raise money, even if it's at the current valuation, and get more money into the door. And then please be prepared that the times will not come back anytime soon. This is an important point because we are all, in a way, you know, spoiled by what we've seen in the post-COVID. Yeah, the V-shaped recovery, this is very different, this crisis. We are facing here very different from the financial crisis. It's not a demand crisis, it's a supply crisis. Demand you can fix with governmental spending and with central bank intervention. Supply, that takes longer because we have broken supply chains. So the current recession will last. And this is the core message. Prepare yourself for a longer period of time. And this is nothing that can be cured in the next 12 months.
So what I would add to that is that with every crisis comes an opportunity. So we've also seen a few startups who are lucky enough to be in that leadership position in the market, taking advantage of the consolidation in the market. Also, acquisition of top talent is a lot easier. The last 2 years have seen, you know, I mean, it was a very difficult task to find good people at startup prices. That's a lot easier now. So I think these 2 points are very important because that's sort of the consequence of what's happening in the market now. I think extension of runway is extremely important, and we spend a lot of time looking specifically at how we can extend runways for our portfolios. Having said that, those companies that have shown really great growth rates and can raise, even though they don't need to because they do have enough runway, we encourage them to do so, just to have this additional cushioning and leverage the first 2 points I mentioned of the market dynamics, which with more cash obviously is easier. I think topics such as internationalization have to be really thought out very carefully. Maybe not the best time to do it aggressively or as aggressively as in the past. But what I always say, and it's easier said than done, is extend your runway without compromising growth too much. Because, as we said before, obviously there's a lot of dry powder. In fact, we have probably 5 times more dry powder in the market than we had 5 years ago. So on a long-term basis, we're actually in a really good spot. So there is money to be raised, but you have to show something for it, and you have to show milestone achievements. And without that, it will be very difficult to raise a up round or a reasonable round for you as a founder. So these are the things that we advise our companies to look into, and we work very closely with them because obviously at early stage, we're also very involved investors. So yeah.
I think building on that, I think we have to differentiate growth stage that precedes seed and early. I mean, for a pre-seed round, if you wait 36 months, you are getting so slow. You need cash to speed up and to consolidate your position, and that there are not others taking your place. So although there might not be so easy the money, there is money. There are a lot of people investing, taking more time to invest, investing less money, but they are investing. So although we are asking the companies to have a sustainable business, we are not saying they have to be only sustainable, they have to bet for growth. So this balance, it's difficult, but we cannot wait and grow organically and slowly for 36 months. This is not startup. We want exponential growth. And for this, usually you need money. And if you are good, you have good metrics, you have proven, you will find it because there is money outside.
And for us, it's pretty much the same, but try to add a few things. There was one company that actually was experiencing supply chain issues, just because of the situation, more from COVID times, but also from the war with the Ukraine. And there was one company that was experiencing issues with closing of a market, Ukraine, so they were planning to sell some agri-tech there, which is a big market. So these things are affecting us, but in general, I think the biggest problem for at least Southeast Europe is the increase of price of good talent. Because of the inflation, because of the rising prices, because of everything else, and the competition from the multinationals, and also US startups setting headquarters in Bulgaria or Macedonia or Romania, the salaries level have risen up, and that makes it very difficult for a local startup to compete in terms of attracting and retaining talent, which will, I don't know what will happen when the recession kicks in, but probably it will not get any better.
So basically there is also a certain time lag that you're seeing in your region in comparison to maybe hubs like London, Paris, like the dynamics there in hiring, pricing of talent. So we just heard it's easier to find talent in some region and for some companies now, whereas you mentioned basically the international competition and the headquarters that are coming more and more also to your region.
Yeah, that's actually the effect of this, because everybody was coming there to hire cheap talent, but they started little by little to become pretentious, and they were selling themselves, I mean, the talent to all over the world. And okay, naturally they were taking salaries similar to the Western world, especially for tech talent. And now the startups are experiencing great difficulties to attract this kind of talent when they start to grow. Of course, the founding team and the first employees are easy to get and inspire, but after 1 or 2 years, that's the issue that they're facing.
Mm-hmm. Makes sense, yeah.
I think it's also important for startups to not be afraid to charge their own customers in line with inflation. I think it's almost expected in these markets, and I think that helps a little bit also, you know, down the line with paying higher salaries in line with inflation.
Yeah, that leads me actually to my next question, which is around business models and how you assess different business models nowadays, because we have seen a lot of businesses that were basically focusing on growth, acquiring customers, charging nothing or close to nothing, depending on what they were selling. So how do you look at these models today, and what are the I would say the key factors that come into your decision making nowadays when you assess business models and various market expansion approaches?
Yeah, I always hated freemium models, to be honest, as an investor. Sorry, please.
What I can say on this is that we are very much focused now on profitability. So what we're trying to do when we are assessing a company and also when we are investing in it, to make a very deep financial due diligence on their business model and how they make money. If they calculate the cost of goods sold in the right way, so they have the right gross margin. And we are trying to place more focus in that rather than on growth. I'm not saying that we're not interested in growth, but we are not interested in growth just for the sake of it at the moment, because they reach very soon this phase where they will have to show this kind of potential for being profitable, and I think this is the biggest change. So I mean, profitability and making money is much more important than the growth potential, and hence these freemium models are becoming kind of obsolete in many directions.
If I may add to this, there is a famous quote from one of the founders of one of the largest tech investors in the world. And he said, I've been working with my directors and principals over the past 10 years, but I still don't know whether they are good investors. And now really is the time to differentiate. And what we are seeing in data is interesting and goes exactly into your direction, is there's this famous, and many people are familiar with it, rule of 40. Rule of 40 is the combination of your profit margin and your growth. Yeah, and that has to be above 40. And the more you are above 40, in a better place you are. And what we are seeing in the data is that valuations contracted massively in the non-rule of 40 segment. And if you are a company that fulfills the rule of 40, you still have a very good chance to get decent funding. Is a wonderful time, not at the valuation levels, of course, from yesterday. In Q4, to give you two stats, which I found interesting, Q4 last year, forward-looking revenue valuations were on average at 44x, 44 times. This has contracted now for the best companies to 18 times on average, and best is in the rule of 40. So there is the hunting ground for any investor now. Cheaper valuations. In my view, they will come back not to 44, but over 18, and companies that really deserve funding.
To add a different perspective, which I agree with them, but just to be different, we focus a lot on trying to have recurrent revenue and be fully scalable with a tech base, so you don't need to invest on cost of goods to get more profitability. So there is where we think there is a huge opportunity, and we have really huge and great talent here in Europe. And maybe we are not betting enough for them, so we need to invest more there, just claiming to put money in this innovation and these startups, because really we have excellent people here. So scalable projects with recurrent revenue, because then once you have the customer, I mean, it's easy to keep them, it's easier to recover if they leave and everything. Getting a new customer is where you have the problem. That's why I said also, I mentioned before, that it depends on what you want money for. If it's for marketing for attracting new customers, that will be because you will depend always on this money. You need to get the customers organically or because they just come back. So, yeah.
The only thing I would add that at early stage, I mean, it's very hard to invest already in a profitable business. Very often they're not yet profitable, but you have to understand the route to profitability, in what timeline it will happen and how they will achieve it, and whether the assumptions are reasonable and rational, especially in today's macroeconomic climate. The other thing that I would say is, even when you do pilots in a B2B business model, let's say, it's quite easy to get a free pilot or a pilot for 500 euros from a huge conglomerate. It's pocket money for them. So what I always look at or try to look at, and this is from my times when I was also operationally active in a startup myself, is that it's a significant enough number that there's commitment from the customer as well to convert, and that they will throw the resources and people at it to make it work. So when I look at pilots, which is often the only thing a startup has at seed stage, I always look at what are the pilots worth, because it's a very strong indication of how big a problem they're actually solving for these companies.
Just to mention one thing on that, because one of my favorite metrics is looking at the cohorts, which means, you know, how long the people stay using your tool for each week. And it's different from the daily active users and monthly active users, because at the end, if you have some users engaged that they really use it every day, every week, I mean, they will pay for that and they will keep there. So for me, I agree, this is one of my favorites. And the other thing, it's true what you're mentioning at the beginning, you know, the metrics show maybe a trend, but the real challenge is not selling 20K a month or 50K a month, but it comes when you have to do 1 million every month. That's the real challenge, and you don't know when you're investing at really seed stage, but you have to see if the team and, you know, the foundations they are building will make it viable to do it.
Amazing. So we have roughly 10, 12 minutes left in our discussion, which I would want to use also for M&A and exit projections that you for sure have made in your teams and for your portfolio. That's of course always like reading a little bit like in the dust or in a dark room, but still there is on the one hand experience from previous crises and also basically industry feedback that you're receiving. Looking at your current portfolios and also the funds that are being raised right now, what are the biggest changes that you see for the next 3 to 5 years in potential M&A, exit, and maybe even IPO scenarios, if they still exist? I don't know.
Yeah, maybe quickly on the chances. And Look, one of the mistakes of the past has been, in the past 10 years, that business models got, you know, number 2, number 3, number 4 in a segment and not the category leader. They all got money. This money is now stopping. And the great chance for, you know, number 1 and number 2 is, of course, consolidation. And there are many, many subscale businesses that will not get any more funding, which is great, and which is another reason to invest into venture and private equity now. They will not get funding, so what's going to happen is that you know, there will be consolidation plays. That's one thing, and one important theme. On the exit side, of course, you know, when it comes to late-stage exits, IPO markets are down. This is not forever. You know, this famous SPAC phenomenon. I'll give you one stat, which I find interesting. 98% of all SPACs are expiring. So no deal. So the public markets are probably closed down for the next 12, 18 months. But we should not forget that corporates are sitting on record levels of cash. Yeah, they have all very strong balance sheets. So I would expect that corporates become more active in M&A, also in the venture and tech area. So there will be also exits plus consolidation.
Thank you.
That's what I think for my region is going to be very realistic, that their acquisition from strategic buyers, I mean, we don't have a lot of IPOs, if any. So that's in 3 to 4 years when we will start to have to sell our companies. I think that the market will be in the right place. Of course, if the companies we invest in strategically conquer markets that are interesting for those guys, because most of the people that are starting some kind of business, they kind of have this vision just to copy somebody and just enter markets where we don't have a leader yet there in this market and sell it to them, which rarely works. So the ones that actually can deliver an exit to the investors are those that start from day one to think about the DACH market, to think about the Western Europe and US, and that's what we want to encourage so they can become sellable.
Thank you.
Okay, so I will tell you a little bit of Spain. In 2021, we had 68 exits, and in 2022, so far, 52. And although we have had some over 1,000 million, if you go to the average, it's around 100 million. And although I would say now it's not the best time to sell, when you are talking about these sizes, usually it's not a cash operation, it's exchange of shares. So this is easier or more likely to happen than when you have to put cash over the table. So I think if you really want a cash operation in the near future, that's not the right moment right now, but if you want a strategic operation where you can grow with another partner and there is exchange of shares, I mean, there is need for consolidation, as was mentioned, and probably, I guess, in 2-3 years, we will have more opportunities for cash operations.
I think big corporates who might be the acquirer in this case are also becoming or are already very cost sensitive, of course, with what's happening in the markets. And therefore, they are also looking for solutions, also within the tech and innovation space, to some of their problems. So I think companies that help with, efficiencies and costs will have a great chance to be a potential target. And we have seen in our portfolio quite a few approaches actually from big players in the market who, quite frankly, are probably also hoping for a, you call it in German, Schnäppchen, a good deal, let's say, in those times. So I think on that path of exit, there are a lot of opportunities that we can leverage right now. On the IPO side, I think anyone who probably wanted to aspire to do one this or next year will hold off if they can. But thereafter, as you say, the market will have to pick up because there's just too much money in the market to just leave it sitting, and it has to be deployed.
If I may quickly, if I want to, can add to this. I've been investing in tech since '96, and I'm hearing, or I heard every time when there was a crisis, 9/11, so 2001, 2008, 9, and now again, tech is dead. That's the biggest mistakes. If you read the data, the contrary is true. Tech emerges stronger out of each crisis, each one that we have seen, than ever before. And there's another stat that I want to share. Currently, you know, we all say maybe this trend comes to an end, but so far, in terms of global GDP, and we are talking about 30 trillion, only 10%, 3 trillion is the market cap of all tech companies together, has been disrupted. And if you talk to all experts, they all say this number, this disruption number of 10% over the next, 5, 7, maybe 10 years goes up to 40%. So we are seeing a 4x need in funding and a 4x need in opportunities. And this is why I'm convinced, and this is one of the big themes at Moonfair, our investors, they go long in tech and growth.
Yeah, I mean, honestly, I totally agree. Tech is dead is kind of a contrarian view I would not subscribe to. I mean, also looking at the big issues that all of us are facing in the various industries that we are investing in. I mean, starting at climate, moving over to health. There are so many issues that most likely will only be solved with tech and by tech. So I hope that European investors and founders especially will double down on that, because otherwise there's going to be quite some difficult times ahead. Yeah, with this positive note, I would actually start the very last round, moving closer to the end of our discussion, asking each of you to share one either insight or learning that we have not discussed yet that you think might be relevant for especially the investors in the room, can be either on the vertical that you're interested in or also the stage or the region when considering investing and the outlook of investing in Europe in the next 12 months.
I'll be very direct. We have to keep on going. Just participate and follow what's going on. Maybe, with smaller tickets, more careful, negotiate hardly the valuations, and just chip in. So there will be better times. But at least 1 or 2 years, but there will be better times.
Thanks.
So I'll say something slightly different. On a more human level, all numbers out of the equation, I think it's very important that we support our entrepreneur in exactly those times. In good times, the investors who have tried to squeeze for every penny will be remembered, and we're here for the long term. So it's important to maintain that good relationship with the tech ecosystem, and obviously you have to bring a return for your LPs and therefore have to make intelligent investment decisions. But when you negotiate terms with the founders, think long term and not short term.
Couldn't agree more. Let's do win-win, because at the end we really win all together. So you were saying tech is dead. I couldn't stand talking about that. Tech is not dead. At least in Spain, is the only industry that is growing employment at 2-digit growth. So this means something. We really need people there. So the companies are growing. Support entrepreneurs. The best opportunities are now, really, the investors who invest on crisis and the founders that are born in crisis, and to be the most profitable, the better startups. So now is the time to put money in there, support them with a really friendly relationship, because on the long term you will have returns.
Look, fully supportive in terms of what has been said. Another point that I want to underline, and I said it, the past 10 years, or more or less every fund made 2x. This time is over, so manager selection and finding the right managers that are equipped to weather to capture the opportunities ahead of us, it's key. It's not anymore an index, it's really finding the right GPs, and that's an art.
So thank you, everyone. A big round of applause for this great panel, and thank you for joining.
Yeah, thank you all for your insights and also for putting the current situation in a quite positive mood. And we've heard there is an inflow of talent. There are really great founding teams around who just need investments. And we still have a strong early stage. And there are a lot of opportunities to invest in the CE region. So I think to sum up the panel, the tone is to really start or not stop investing. And now I have the honor to welcome Eva Landrichtinger, the General Secretary of the Ministry of Labour and Economics, on stage. Welcome. So, adding on to the previous panel discussion about current challenges, international talent and also the private funding would be the main game changers to keep the industry growing. So we will go deeper into the plans today from the government side.
Thank you. Thank you very much for the invitation. I'm very happy to be here.
Perfect. Nice to have you. Starting with the first question. Just recently, Austria's reform for its permanent resident for skilled workers, the so-called Rot-Weiß-Rot-Karte, has come into effect. How can this reform facilitate the access to global talent for startups and also bigger corporates?
Yeah, so the reform of the Red, White, Red card is in place since the 1st of October, and its goal is to make the recruitment and the labor market access for qualified workers of third countries more easy. And we made a few amendments, so we changed the minimum wage of the so-called other key employees, so die sonstigen Schlüsselkräfte, and we also changed the scoring of qualifications of the work experience requirements and also the language skills. So the thing is, in the last years, the Red, White, Red card, we didn't have so many applications, and we really hope that these changes will increase the applications. Another very important thing that we did is that we implemented an employment permit for specialists, so for persons that will be here for special projects under 6 months. I think that is something that is very important for startups. And we also implemented a special unit in the ABA, the Work in Austria unit. So that's a unit that will support especially companies during the process of the Red, White, Red card. I think you all know it was a little bit of a very difficult process to get a Red, White, Red card, and so we hope that with this reform it will be easier, it will be quicker, and that we simplified the process of the Red, White, Red card, and we will see and hope that the applications will increase in the next few months and years.
Yeah, please also spread the word and also attract international talents, international GPs also to the funds, invest in international startups. It got way easier, and we're also hoping for feedback out of the community for the process to keep improving it until it's so easy to work in Austria. So coming to my second question, and here we will talk about the funding situation. Which measures are planned to support and foster newly founded startups and venture capital in Austria, and what can entrepreneurs and funds expect?
Yes, so the Austrian government, I think, always said that innovation is a key driver for long-term competitiveness. So that is why the public sector has a broad hopes to help on a very broad level. Why do we do that? Startups play such an important role for the economic system in Austria, and I think in the current situation with the energy crisis and the economic effects of the war in the Ukraine, I think it is very important that we, from the Austrian government, support in this field. We are very happy to rely on our national agencies. I think you all know them. We have the AWS, the AVS, our federal funding institution. We also have the FFG, where they try to close the funding gap that sometimes is still here. But yeah, we are well aware that the availability of venture capital is still lower than on EU average. So we also try to improve the situation with other measures like our new legal form, the flagship. We are negotiating with the Ministry of Justice, the Ministry of Finance. It will also include an employment stock participation. And I think one thing we are familiar, or you are familiar with, is the AWS Gründer- and Mittelstandsfonds, and I'm very happy to say that this fund will continue, and we are working at our ministry at the moment in the preparatory phase so we can keep this fund going.
I think we have to say that even louder, and I think this is also the first public announcement that the Gründerfonds is finally being continued, and I think this is really good news, and especially good news for the investment industry. I think a lot of Austrian funds have invested with the Gründerfonds, and it really helps to put the startup scene where it is today. So thanks for sharing this with us.
Thank you.
And thanks also for being here and joining us at Invest Austria, and we're looking forward to a good collaboration in the next years.
Yeah, thank you very much and have a great day today.
Thank you, Eva. So we have one more point on the agenda until we reach the first break of today. We have heard a lot of numbers today, but we will go even deeper, and we have the experts from EY here with us today. I can welcome Georg Pekodovic and Mikolaj Borowski. Welcome on stage.
We already had a couple of very warm welcomes at the beginning, and of course, I want to join in that on behalf of EY as proud sponsors of Invest Austria. Sorry, wrong direction. Even though the picture that we have chosen as an intro might suggest different, but don't worry, we are not the ones who are taking the pessimistic view here. The next 15 minutes, my colleague Mikolaj and myself will share some of our observations, figures on the current investment climate and the outlook for Europe, and especially the region we are working and living in, Central and Eastern Europe. So before we go into a bit more figures, allow me to briefly set the scene. And we've heard a bit of that already, especially in the panel discussion before. But I think it's worthwhile summing it up, because you cannot speak about investment climate without having a picture of current development in Europe. When we met for last Invest Austria in October 2021, the general mood and outlook was extremely positive. The worst of the pandemic was overcome. Interest rates were still at record lows. Inflation was under control. Economists predicted solid growth for 2022, 2023, and the years to come. And even governments were making first slight attempts of getting out of the crisis mode they've been in the 2 years before, during the pandemic. And if those were here last year, actually, you might have recalled the opening speech of the former Minister of Finance, Gernot Blümel, who promised that very shortly after last year's Invest Austria, we would have a new fund law in Austria regulating VC and PE funds, and the long-awaited startup package for the Austrian startup ecosystem with tax and corporate law reforms. Well, how fast things can change. Only a couple of days after last Invest Austria, the former Chancellor had to step down and send the Austrian government fully back into crisis mode. And sadly, most other European governments had to follow, latest beginning of 2022. And of course, you all know why. We had this before. In the aftermath of the pandemic, we were hit by multiple crises piling on top of each other, record inflation, disruption of supply chains, shortages of raw materials and labor, central banks having to react to the soaring inflation by raising interest rates at record speed, and all of that leading to economists predicting a recession now for 2023. So governments had to go back to fighting the effects of that crisis by spending much more money, and we'll see where this has led to much more inflation, as we've seen over the last couple of months. Yeah, where are we now? Is it all doom and gloom, or is there also reason to be optimistic? We definitely think so, and we heard a lot of those reasons before. And we also believe that the fundamentals and the figures support that. Nikolai.
Yeah, so if you look at the numbers, so you obviously see that there is a drop down in terms of investments in comparison to the pre-COVID times. Yeah, but what's interesting to see that we see a growth of those investments. So if you compare 2021 to 2020, you see that there is a 5% of growth. Yeah, we are still 12 points below the records in 2017, but you see that the foreign investments are growing. And so what will be the 2022? Yeah, so we heard a lot about the risks that are right now. So obviously we have a war at Ukraine, which doesn't help our region. We have high inflation, high interest rates, breakdown of the supply chain. So all of those factors are the factors that based on which maybe the outlook isn't that very positive. And last week I was on our conference in New York, listening to the private equity funds talking about what is the future. And they were saying two things that I think that are quite interesting. So first of all, they are saying that the next 2 years for them will be rather slow. So they are expecting that for the next 2 years the investment will not be that high as it used to be. But what they are saying that they're thinking mainly about the acquisitions of technology. And also funding their existing investments in order to build a platform, investment platforms, yes, so doing an add-ons in different jurisdictions. And if you think about this, I think this is a big opportunity for our region. And EY recently made a survey among our clients, investors, which regions do they believe are the most attractive regions. And if you look at the results, so in the first place is Western Europe, but Central and Eastern Europe is on the third place. And why is that? So I believe that our region will be benefiting from two things. So first of all, the disruption of the logistic supply will result in transferring some of the productions to Europe. And obviously, Central Europe with a cheaper labor force, but relatively high qualification of the workers, is a very attractive region for the investors. And secondly, and we already discussed this in the previous panel, we'll discuss it later on, the technology. So the companies are right now looking for acquisition of the technology, and we have this technology in our region. It's relatively cheap if you compare it to the companies in Western countries or in other regions. So I believe that this may be a driver for the acquisitions and investments in our region. That is why, where in the survey, the investors are indicating that, the perspective for the Europe and investment here is relatively good. If you see the numbers, so 64% will say that the attractiveness will improve either significantly or slightly. Yeah? So it's a very positive, I would say, numbers, given that we currently have war in Ukraine. If you look at the number of the financing, so you can see now in Europe, the 2021 was a record level year. In our region, well, it's growing. It's not that high as it used to be it's not that record as in Europe, but you can see the steady growth. Well, this year there will be a bit decrease, but it's not that much. Yeah, so it'd still be relatively high.
We heard about that before in Q3. There was a 40% decrease. Still, that did not translate into that massive decrease. If you look at the figures of mid-September, we had 5,700 financing rounds reported for Europe. And if we project that until the end of the year, that would translate into 7,200 roughly, which is only a decrease of 14% compared to previous record year. Let's see, if that's really going to be like that, the figure at the end of the year, but it will definitely not, fall to pre-2020 levels. Similar picture, even better picture, if you look at volumes, they are, on the basis of latest figures, might not even be a decrease ending up this year. As said, these figures are probably not considering the very latest developments, but the sharp decline this year will not be that bad. The big question is, of course, how will it be next year, in 2023? And if we are honest, we all don't know. So what we suggest is that in times of a bit more uncertainty and coming from a period where we had record valuations in the traditional startup hubs, Western Europe, it might be more worthwhile to look at a region that has probably not been as in the focus as were those regions. And that is Central European region. And before we go into the deep dive, allow me one personal note. You will see the authors of those studies did not consider Austria as part of Central Eastern Europe. Interestingly, I think that can be discussed. My personal opinion is Austria is an integral part of Central Eastern Europe because it has very strong ties, historic, social, cultural, economically, over the last decade. So, yeah, in the next edition, it should definitely be considered there. But for today, we will make a quick deep dive, not to extend the time too much, into CEE. Nikolai.
Yeah, obviously, before we go into deep dive, you must take into account that, those countries have their specific. So there are differences between countries of CEE, yeah? Although you can see some common ground. So the inflation, like, for example, is relatively high. The war for talent is in almost every country of our region. So even though that there are significant differences between those countries, you can find a common element. So as I said before, so the number of the financing is not that high as in the Western Europe, but it's still at a very good level. But what I think is more interesting is that the amount of the financing went significantly high. So you can see that it's almost double the numbers from the 2021. Right now it's 3 billion euro, and we believe that it will be 3.8 billion until the year end. And what does it tell us? So I think it tells two things. So first of all, the valuations of the company went higher than it used to be. And secondly, the amounts of the single financing are higher. If you look at the countries, so in the first place we have Estonia, Poland, Czech Republic. So they are, especially Poland and Estonia, are significantly higher than the other countries. But still, Czech Republic, Lithuania, Romania, in terms of numbers of financing, they are relatively high in the region. In terms of volume of the financing, so we have seen that Estonia, they're be the same countries apart from Croatia, which had one of big deal. But in terms of volume, you can also see that those are the same countries. And what you can see as well is that the amounts of the financing are increasing significantly, which is a very good thing, I would say, for our region.
So summing up, why should you look closer at CEE and why should you consider an investment there? Enterprise values have skyrocketed over last year. No end in sight, we believe, still holds true in the medium and long term. You will see there's a statistic showing that in 2021, the combined enterprise value of CEE tech companies has increased to 186 billion euros. Yeah. There have been unicorns created in the last, especially in the last 5 years, the total number increasing to 34, with the time for a company needing from startup to unicorn decreased by 60% since the fall of the Iron Curtain in the 90s. CE is the home of tech. It has a tech-savvy workforce, very talented programmers, and tech is definitely not dead, as we have heard before. 2 more reasons.
Yeah, so it's very interesting to see, what is the, let's say, composition of the investors in our region. So you can see from those slides that on the left-hand side, if you look at the composition of the where the capital came from, so you can see that in CE only, well, it's below 10%. It's a domestic investors. Yes, the majority of the investors is outside of Europe. It's different in the other European countries, like for example in France, the majority of investors are domestic investors. And it's also interesting to see that, if you look at the volumes of the financing, so the domestic investors invest at the seed or Series A level. Yeah, if we go to the Series B or Series C or mega rounds, there are significant drop down of domestic investors. So there is like kind of a quite. We are quite welcoming the foreign investors, but what does it mean? I think it means there is a great opportunity for the angel investors here and VC investors in our region, because there are relatively small amount of those investors. Yeah, the main investors right now are international investors in our region, and this is somehow confirmed on this slide. So if you look at the unicorns that were created in our region, you can see that 35% of them were bootstrapped at the beginning. Myself, I had a conversation 1 month ago with the owner of a 3D printing company. They are doing also 3D, the bio 3D printing, and he told me that he had to take an unsecured loan, borrow money from his parents to save his company. Yeah? So you can see that in our region we are lacking of angel investors, as for example the bootstrap unicorns in rest of the Europe is just 7%. So it's still a great opportunity for angel investors to invest in startups companies. So to summarize, yes, so why investors should invest in CEE? So we've discussed this. So there is a great tech companies that you can invest in our region. The founders are passionate founders with stamina, and the valuations are still relatively low if you compare it to the Western Europe. So I think that all of this makes is a great place to invest. Yeah, so go east. Thank you very much. I want you to have a nice conference, and I hope you will have fun during the conference and during the drinks at the end.
Thank you. Thank you, Georg. Thank you, Nikolai, for your insight. Thank you very much.
Thank you.
Well, I think so far we heard a lot of good news. Tech is not dead. There's still a lot of dry powder, $1.5 trillion. The current managers in charge are actually experienced. They have experienced some crisis before, and they are looking for solutions instead of bracing for a crash. I think all over it's a positive note. I think it's time for you now to start networking with other participants. So let's move on for a break, and thank our partner Deutsche Private Equity for the support. We reconvene at 11:05 for the second panel of the morning. Thank you very much. Welcome back. Now it's working. We hope you enjoyed the break and started to network intensively. We'll now start the second part of the conference, of the morning program, with a second panel focusing on impact investing. And I would like to invite Julia Zhu, co-founder and chief development officer of Tidal Impact, together with our panel. First mention that Georg Lehashka is today sick and could not join, but by chance Alois Flatz could jump in and take part of the discussion. So welcome, Alois. Petra Salesny is a managing partner of Alpha Associate. Bernd Schneiderbauer is partner at Binder Groswank Attorneys. And Lubomila Giordana is co-founder and CEO of Plan A. Julia, the floor is yours.
Amazing. Can you all hear me? Hello, hello. Wonderful. Welcome back, everyone. Hope you had a good break, are well fed, and are ready to listen to these amazing panelists about the topic of impact investing. So I think everyone's very interested in learning more about who these amazing people actually are. So the first thing I would like to start with is to ask each one of you how you actually got to where you are today. So what, especially diving a little bit into your personal motivation, you know, what's the story behind it? Why are you doing what you are doing today? Maybe we start with Lubomila.
Thank you so much, Julia. My name is Lubomila, I'm founder and CEO of Plan A. My story is actually starting with the finance industry. I've been working in investment banking, then I was in VC in Asia, then moved back to London to work in fintech. And climate change found me on a beach in Morocco, where instead of surfing, I ended up cleaning beaches for a week. And after that, found myself a bit disillusioned with the reality in which I was existing, which was clearly aligned to a path that I was confirming for myself for a long time. But after 1 year of investigation, I decided to delve into the entrepreneurship sphere and build Plan A. For those of you that don't know Plan A, we're a software as a service platform that enables financial institutions in the context of today, but also other industries to decarbonize, track all of this through one single system, and then align to policy, because obviously there's a lot of different legislations. My personal motivation has been the fact that I got overwhelmed with a lot of facts about climate change, and I couldn't see any other way to use my skills in an effective and also purpose-driven manner. 5 years down the line, it feels like a good decision.
I mean, Plan A is, if you haven't already heard about it, quite an amazing company, so kind of recommend checking it out for sure.
My background was I started to do pro bono work, and I advised Teach for Austria in the beginning. Some of you may heard of Walter Emberger, and so I got into that. And my personal motivation was always to diversify the people I work with. I always loved that and still do. And so I got into pro bono work in the beginning, and then met some people with some impact background. Peter Scheuch was
based private equity, private debt and infrastructure manager of funds and customized accounts for institutional investors. We have approximately 9 billion euro assets under management for primarily pension funds and insurance companies in Europe, and we are just launching our first SFDR Article 9 private equity impact fund of funds, including co-investments, so very excited to be here.
That's amazing. And what got you into that field in the first place? What's your personal story behind that?
My personal story is that I'm a lawyer by training, so not the most logical path. I'm Austrian. I studied in New York. I ended up in Switzerland for personal reasons, and I decided to stay there and give my career a try in Switzerland. And as you know, law is not a very transferable profession. So I moved into M&A and private equity investing, and that's how I ended up where I am today. Yeah.
That's great. I'm sure there are a few lawyers sitting here as well, so maybe we can draw some inspiration from that. Alois.
Yeah, hi. I'm Alois Flatz, and when I finished my my master's in business administration, I was trying to give my life a bit more of sense than doing accounting or something like that. And I then got the opportunity to do a PhD at St. Gallen University with a focus on circular economy, so on the interface of business and sustainable development. And that was in 1992. The term circular economy in English didn't exist those days. And when I handed over the thesis in '94, December, I said, if I can nurture a family or my life, then I will stay in the field of sustainable development. That was in 1994. And in the meantime, I'm nurturing 4 children and a wife. And I then joined a startup. We were a pioneer in sustainability investing in Zurich. I was there responsible for products, and the most well-known product is the Dow Jones Sustainability Index, which we launched in 1999. I then moved into venture capital, was a partner with a venture capital company in London for 2 fund generations. I then worked for Generation Investment Management, which is Al Gore's investment company that he co-founded and is still chairing. And I started alongside that doing some business angel investments, all in the impact space. And I just decided to launch another fund focused on high-tech impact startups, Series A+.
Wonderful, amazing, thank you very much. And hope we all got a bit of a glimpse into what actually the motivations are behind what all of you are doing. And of course, this whole panel is about impact investing. So I actually want to understand from you, do you think you know what impact investing means? Raise your hand. If you feel like you've got a confident understanding of what that means. Okay, so I don't see that many hands, which actually is good for us because then we can bring in some of our own opinions and perspectives. And so from my perspective, also as an impact investor, I know that the term impact investing can be quite confusing. Many people have different understandings of it. So I would like to know from you how you actually understand that. And then we have the startup perspective, we have the private equity perspective, the investor perspective. So what does impact investing mean to you? And especially what actually defines an impact investment or an impact company from a non-impact company? If you would shine a bit of a light on that, that'd be great. And we can start with you since you just said you're raising a new fund focused on high-tech impact Series A companies. So what does that all mean to you?
In my view, impact investing means it's you try to generate an impact that goes beyond financial return. Mm-hmm. And of course, there is a wide range of approaches. It can be more market-oriented, so that you target market returns, or you say, okay, market returns are not that relevant, or financial returns, and you go more into a philanthropic or below-market return approach. Both are relevant in my view. However, I think if you want to contribute to a systemic change, you also have to consider the financial return, because otherwise it's not sustainable on the long run. So as important the below market return approaches are, at the end, the big change you can only generate if you focus on financial return, because that's the only way it's sustainable in my view.
Right.
What kind of impact? Environmental, social, but also an impact to building an ecosystem, for example. These are the kind of impacts, and of course the big question is, how do you measure it at the end?
Absolutely, and I think many would argue that in the future, if a company is not sustainable, they're going to be less profitable. I'm sure all of us would agree. Great. Petra, do you have any inputs, especially since you actually are in the process of creating pretty much the first 100% impact-focused fund of funds, right? Article 9 fund of funds. So that's something interesting to.
Yeah, so we have
as well.
invested in private equity for 20 years, and this provides us with a very long buyout, growth, and venture capital track record. And so we decided it's not a question whether you should raise an impact fund of fund, but you cannot really afford to not raise an impact fund of fund these days. So the way we go about it is because we have pension funds, insurance companies, banks, as our clients, they need to generate risk-adjusted returns. So we want to generate both attractive risk-adjusted private equity returns with our strategy and impact. And we also found that no trade-off or compromise is necessary there, because when we went out and looked at the universe of impact fund managers for our fund of funds, which we did over the last 3 years, we found that there are over 200 that fulfill our investment criteria of achieving true traditional private equity returns and impact. And if you think about it, it also makes sense, because a company that has a positive impact on the planet and on society also has a high financial return. So this is how we go about it. We want to deliver both returns and impact, and we have developed an impact thesis, a selection framework, and a reporting tool, and we have selected 9 of the 17 United Nations Social Development Goals, and focus on the themes of environment and decarbonization, as well as education, healthcare, and financial services. These are our topics.
Amazing. I'd love to circle back actually to that topic of, because both of you were saying we want to achieve both financial and, I'm going to call it, impact return, but I don't know if everyone would agree with that. I obviously would agree with that, but definitely something we will circle back to. So Bernd, from your perspective, also working with the family office that's basically been practicing impact investing for over, 10 years, which is quite a pioneer in Austria, right, in that sense. Let's look at maybe 10 years ago. What were you even thinking when you thought of impact investing?
I can give you a short story on that, the development of our kind of definition of impact investing, or what we understood with it or from it. It's when we started, and we did it really in a strategic way 10 years ago. We employed people, we made a strategy on it, and we said, what is it for us? We started in investments mainly in Indonesia and Nepal, the base of pyramid investments, where we really said, okay, we have a legal framework as well, and I'm an attorney, so I said we have a private foundation here, we have a legal framework. What exactly is that, what we are doing here? Let's look into the deed, and we found, okay, that's not really matching, because that what we are doing there is really charity. In the end, in the beginning, it was charity. We didn't get any, we did not expect really returns. It was good when they came, but they didn't. For some, and so we need to change our legal framework. To make that clear. We have our liability. We don't want that. We want to make it professionally and in a good way, and we changed that. And over the years, we said, okay, there are 3 criteria for us that are required to be claimed an impact investing or investment. And the first one is to separate it from charity. We now request a standalone or a sustainable business model. If we look into the company, we said, okay, in the beginning we said, okay, couple of years we need to have an impact, that's fine, we're done. Now we look at the business model and said it must be in standalone, it must be sustainable. That's how we separate it clearly from charity. The second is, when we look at the pure rational investor, we are of the opinion that a pure rational investor would not invest in that company. Because when we dive into detail of the risk and return profile, we think it's a little more on the return side, less attractive than the pure rational capital market investment. That's how we see it. Of course, there is the impact that needs to be measured and that needs to be done. And the third criteria is we have certain sectors that we focus on and that we are of the opinion certain sectors are not eligible for impact investing at all. I mean, you can name examples for that. So that's the three criteria. And what is different from the company perspective, I think it's also having met these three criteria, it's the mindset. So that comes the mindset of the people you're working with. That's a little bit different mindset you always have to work with.
Mm-hmm. That's really interesting. And yeah. I feel like we could have a whole session just diving into looking at the companies and which companies we should invest in, which we shouldn't invest in. And we'll probably get to that a little bit. But Lubomila, I'd love to hear your perspective in the sense you're coming from the founder's perspective, right? And you've built a massively successful impact startup yourself. So what would you say, makes you Plan A an impact investment, and what differentiates it from other companies in terms of its impact?
It's important to recognize that any company, regardless if we assess it as an impact one or not, has externalities related to its existence. And historically, based on the financial model and the economic system that we've been using, the KPIs have been predominantly focused on the monetary returns, the growth, the margins, and so on. The truth is that there's not going to be any kind of investment different than impact investment in the future, because we're now starting to recognize that all these externalities cost us a lot of money. Be it the negative impact you have on the planet, be it the negative impact you can have on society, or with your activities having essentially the possibility to have an extended negative life cycle that is outside of your realm of observation with the product you've developed or your services. So in that sense, Plan A itself has the benefit of having a business model that is dedicated to decarbonizing financial institutions and businesses. So at the get-go, we have positive impact, handprint, as we were speaking, scope 4, which is what we do with our own existence and what we make money out of. But to make sure that we also fill in all the other criteria, we've set ourselves a set of boundaries where we cannot overstep. And that's the policies that we follow related to corruption, anti-money laundering, even though it seems a bit outlandish for a company that is just over 100 people. Still, by setting this kind of mindset in the way we onboard employees, in the way we also go outside and speak about ourselves, we set the scene for what we should be expected to deliver across the whole history of the company. What we see, maybe following up on everything that was said here from our clients' perspective, that is private equities, banks, VCs, is that these negative externalities that are not accounted for at the moment are actually starting to show up at the bottom line of many businesses. Only last year, insurance companies, one in particular, Munich Re, paid 68 trillion. There was unattained costs, unaccounted for, of climate risk, assuming that insurance companies have actually the best climate risk-related models. You can go into such examples related to other types of negative externalities. This is happening now, and that's also allowing for everyone to start reassessing, is sustainable growth from a financial perspective really the truth if it doesn't account for all these KPIs?
100%, and I love how you frame it as it's almost like it's a must-have, right? It's not just a nice-to-have, and that's, I feel like the industry, or a lot of people still see it as, oh, it's a nice-to-have to look into sustainability impact, whereas really in the future, if you don't have it, it's going to massively impact your business. And so I'd love to stay with you, actually, because you mentioned your clients are predominantly private equity firms, VCs, banks, and I'm sure that not all of them are saints. And actually just the other day, I think it was yesterday, a friend of mine showed me a list of, it was called the 100 top sustainability leaders. And among the top 10, I'm going to call out, was Coca-Cola, for example. And I'm sitting there thinking, I don't know if I would agree with that necessarily. And so among all the companies that you've worked with, what would you say has been working, and what would you say, was just pure greenwashing, and what can we do about it? But I'd love to just shine a light on that. Yeah.
It's important to depict the two ways in which you assess positive impact. On one hand, you have all these KPIs that allow for a company like Coca-Cola and even Philip Morris, that if you look at their sustainability report, is claiming itself to be a health tech and a health kind of wellness company. That's the cigarette company, tobacco company. And then on the other hand, you have these companies that really are truly transforming themselves to become sustainability pioneers on all levels, where they've understood themselves as not so positively impacting the environment, but then they're switching into a model where they're becoming better at that. We don't only work with private equities, VCs, and banks. We also work with companies like BMW, Audi, but also fashion companies like Chloe, Ganni, and I can continue listing utilities like Vattenfall. And where I personally, and I can go into the Plan A methodology as well, but what I've learned over the years to be able to judge on who means well is when you see a few criteria. The first one is actually resources, and that doesn't mean massive budgets, but it also means full-time people working on the sustainability agenda, on the agenda to transform the company. That is not necessarily only the innovation team. That is by itself a demonstration that the business understands that this is where money will be lost. The second element is related to an open communication across the whole organization, and that is absolutely dominant in the financial industry, where if you ask a random cashier at a bank branch and you discuss with them the sustainability strategy of the company and then not able to respond, that shows how far they've gone into really dedicating themselves to the particular commitment they've made. And then the final element is really looking into these externalities, but also going into stakeholder management. If we take an automotive like BMW or any other company that has a physical product, there you're talking about a big demonstration of negative impact associated to suppliers, because this is where majority of the emissions, majority of the also maybe practices that are not so sustainable, not only from an environmental but from a social perspective, could be sitting. If they're not engaged at this stage, that means that the company is not yet really mature with the approach that they have. I want to make a disclaimer that we actually have a selection criteria and a blacklist of types of industries and companies we don't work with. So I can comfortably say that we don't work with anyone that is doing greenwashing. Chase me on that, go on all the websites and communication that we have. But we made it a commitment at the get-go because we think that we have a limited amount of time and we should dedicate it to companies that truly mean business.
Mm-hmm. That's good to hear that you have that integrity within your company. Great. Maybe, Bernd, I'm going to come back to this family office topic because I'm sure that lots of people here actually work with family offices as well. And there are two things that we touched on. So one was the whole topic around impact investment. So both of you were saying we need to have both financial return and impact, right, for a company to be considered a true impact company. And then you were alluding to impact investments potentially delivering below market returns, right? And so what's your stance on that? Do you think that's an expectation we should continue to have, that impact investments may mean concessionary investments, or where do you see that in the future, especially from the family office perspective, as family offices are often a bit more flexible, right? And sometimes even connected to philanthropy or some of those areas.
Yeah, that's not easy to answer, but we needed to separate it from our venture capital investments that we have also in our family office, and made a clear distinction to that. And that's how we have come from really, we said, charity up to this sustainable business model with a lower return compared to risk profile, as I said. And if I look into the future, I think there is still, it's still ambiguous a bit, impact investing, because of course we all want to make the world a better place, but we are not really wanting to give up any return on that, so not at first hand. So the ideal world would be, okay, we make the world a better place and get higher returns with that as well. Of course we all want that, but I think that's not the reality, at least we are not believing in that. Maybe in the future there will not as an overall market, you know, if you take all the investments, and I don't know all the investments, impact investments in Austria, but we are one of the first players. We are well known. We do that for quite some time, and it's and we compare it to our VC investments. We see that lower return.
Right.
So that's, yeah.
Thank you for your opinion, and I'd love to invite Petra and Alois to chime in here. I wonder if you agree or disagree. What's your opinion?
So I disagree, and not just to make this panel a little spicier, but
it's always good.
I think the title of our panel is quite accurate. Are we all becoming impact investors? And I think yes, over time we will all become impact investors, because successful private equity investing is about investing in growth themes and investing in technologies that, I mean, make the world a better place. Yes, let's put it like that, that make the world a better place, but really have a concrete impact in terms of reducing environmental damage, climate change, accessibility and affordability of good quality education, healthcare, financial services to all parts of the population. I think these are big growth themes if we look at the challenges of our world and of our society, and the technologies enabling effects in this respect are growth technologies. So I think it goes hand in hand, investing in these themes that address future challenges, because they are growth themes, and making money out of them.
Mm-hmm. Alois, what do you think?
I think below market return approaches and philanthropy, they are relevant. They're important because there are always people from a social perspective, they fall out of a range, or no one is helping them. It's important for development in poorer countries. It's important to promote education. However, I think from an investment perspective, and we are talking about impact investing, I think everyone is becoming an impact investor. If I look back, when we started in '96, we had to fully educate the market. We had to explain people, if you invest in a sustainable way and take environmental, long-term economics, even long-term economic aspects like HR development, values of a company, into account when you do equity research, you do not lose on performance. In contrary, you can even be better. And people didn't believe us. And then I said, okay, if that's the case, then we develop our own index. That was in '98. You know, this is 25 years ago approximately. And I was able to persuade, or we were able to persuade Dow Jones to launch this financial index. In the meantime, in the coming years, what I see is, I see a lot of driving forces where in 5 years' time, we are probably all impact investors. And what are these driving forces? You have a lot of regulation at the moment that is coming in for corporates, but also for financial institutions. So on a European level, they come in the future, a bank, like a Erste Bank or whatever bank, will not be able to provide a loan to a corporate without doing a kind of an ESG rating. That will not be possible. The ECB this summer published the first climate stress test. They were testing the leading European banks on what it means when climate becomes a real issue. And they were assuming CO2 emission prices in scenarios between 100 and 600. and they were watching how would the portfolios of these companies, the loan portfolios of these companies behave in such a situation. Another driver, if we go towards 2% degree of global warming, just in CEE countries, it needs investments of around 500 billion till 2030. So there are two approaches, and I have seen that over the last 25 years. Either there are so-called, now everyone is called a startup, a startup that launches, as you are doing, a fund, or let's say an infrastructure fund. We all know these kind of infrastructure funds that invest in renewable energy, in photovoltaic plants or wind parks. 30 years ago, they were nowhere. In the meantime, we have that in many in Germany, and billions. They manage billions. In the Anglo-Saxon world, in Switzerland, Germany, a few ones here. They manage billions. Who managed that money beforehand? The incumbent banks, of course. So, for every bank or loan provider, if they see not only the risks but the opportunities they must start with these activities. And in a few years' time, we will not invest in fossil fuel utilities anymore. No one will do that, because if we don't see the scenes now with these high energy prices and the dependencies we have, and it's not a solution now to make us dependent on the Middle East, from oil and gas, they're coming from there, or even the Americans. So we have no other chance, or no other opportunities. We must do it, and for that reason, I can just, and I was recently elected to the supervisory board of Erste Bank, and I will in the board ask the management, and I must do it, otherwise I'm doing a wrong job. Yeah. What are you doing to seize these opportunities, these 500 billion that will be needed in the coming 5 years or 7 years till 2030?
Yeah, absolutely, and I would 100% subscribe to the idea of looking at it as an opportunity rather than a risk. Because if we don't, climate change obviously is, if not one of the biggest problem that we're facing, right? And so if we don't see it as an opportunity to, even as a financial opportunity, right? Reframing it in that way, then, I don't see any other way either.
May I add a short comment to that? I fully agree. If we look into the future, I think impact investing will become, and it is not long to go, will become an integral part of investing anyhow, whatever the term may be. Maybe it's another term, but this will be an integral part for sure. And I think it will not take long as well for being held accountable for doing things that are not impact investing related, or if you say you're greenwash, if you greenwash, and this will, I think it's inevitable that this will
and hopefully come. Companies like Plan A will help us keep these companies accountable. There's one thing I wanted to ask you, Alois. So you started very early, about 30 years ago, when pretty much nobody was thinking about any of these topics. If you look at yourself 30 years ago, and if you see what the world looks like today, are you happy about it? Or what is your thought? Is that how you expected things to turn out? Or are you...
Honestly, I didn't think about it, but when I started, because you just do it. You try to be in the flow, in the now, and you don't think what could happen. We had conversations with Dow Jones about this financial index. Honestly, I was at the end of the 20s. I had no clue what I was doing. I had no clue about the index industry. We were just learning, and I think every startup is more or less starting that way a bit. It's a learning experience, and I learned a lot for myself. And if coming back to what you want to hear about the question is, so many things happened And I'm convinced in 5 years' time, it's fully integrated. It's fully integrated. There's no distinguish.
We should have the same panel in 5 years' time and come back to the same question.
In 5 years' time, this panel is not needed anymore.
Very good point. Hopefully, fingers crossed. Thanks for your answer. And I know we have, how much time do we have? Maybe 5 minutes? Oh, wow. Okay. So many topics to dive into. I'd love to hear, okay, let's talk about two things. And so we had a whole discussion about impact measurement before we went on stage. And obviously, even at Tidal, that's our bread and butter. We work with companies on impact measurement every single day, and we still find it such a chaotic world. There's no standard. It's very hard to say whether, or to define the exact metrics and indicators and all of that. So perhaps, Ludmila, since you obviously with Plana, you've been looking into that, at least from the climate perspective, quite a bit. So what's your approach? You know, how do you measure the work that, the sustainability of the companies that you work with?
At the get-go of Plana, we set up a scientific team. Actually, the first employee of the company was coming from Potsdam Institute for Climate Impact Research, and that really allowed us to set a foundation that now allows us to cover a lot of different standards, a lot of different frameworks, and to also have a certified software for our methodology, which is the only one that is so on the market. This is not making the job easier because we have some private equities, for example, as clients that have to adhere to like 20 standards because they want to be reporting internationally. They want to also be aligned to what the EU is asking them. And on top of that, next year, they're going to have to report on EU taxonomy. And there's a bunch of other frameworks that are coming up related to greenwashing and so on. So how we do it, we follow at the get-go when it comes to the environmental assessment, the GHG protocol, that's where we have certification. And then for the different standards that are applicable to the different industries, like using the one that we're discussing today, we cover PCAF, PACTA, as well as also quite a few other standards, but these are specifically related to risk within the portfolio. When it comes to the general discussion of measurement, I have quite strong opinions because I think it is to some extent hindering our capacity to have impact because there's so much focus on reporting on sometimes hundreds of KPIs without necessarily reporting on the action that comes after that. If you were to ask me, I would be happy if every single company on this planet was to report on 5 KPIs, but then 3 of them are dedicated to the actions that take and to continuously improve, and this is checked on a regular basis. Because it is great to understand the status quo because we can prepare for the future and we can turn these risks into opportunities, but ultimately, let's be honest and a little bit cynical. If we follow the usual approach that the market has had, we can rely on the fact that the reporting is going to be the case of 70 to maybe 90% of companies stopping, where we just gather data and then we prepare a report. What we've seen as a good practice within companies, and I would highly recommend to anyone that has a portfolio or is part of a portfolio here to do, is actually introducing an internal taxing model. That doesn't necessarily mean that you are carbon taxing, of course, that doesn't mean immediately that you are charging your departments. We do have clients that do that, but it's just a really good way to start shifting the mindset about the responsibility associated to environmental footprints.
And it also reminds me, when we look at the whole theory of change, we should focus a lot more on outcomes, right? So not just simply the outputs, but what are the outcomes? What's the long-term impact that all of the activities actually result in? Does anyone else have a particularly strong opinion about how we should be measuring the impact of the companies or projects that we invest in?
So in private equity, this is a huge topic. Our clients want ESG reporting, but there is no real standardized measurement or reporting format yet. So what we have done so far is we have conducted an ESG due diligence with a due diligence questionnaire that we have developed on each of our funds or companies that we invested in. We are tracking compliance with UNPRI or other ESG standards. But the reporting that we receive from private equity funds came in very different shapes and forms. So what we have done last year is we have programmed a tool where we make our fund managers, they love that, every year enter over 80 ESG criteria on the manager and on the fund level, though some have complained quite heavily that they are not ready. So this allows us then to receive homogeneous data that we can actually integrate into investor reports, because it's not enough anymore to tell investors we invest in an ESG compliant manner. They want a report with
to see the data.
CO2 footprint, manager scoring, rep risk rating, etc.
Right. Alois, I see your face. And
I'm thinking about that, and don't get me wrong, reporting is important, and of course, only what gets measured gets done. We all know that. But at the end, if I hear 70 KPIs, we have to think, we must be aware, and also what ECB and the legislator are requesting is, we are creating an incredible bureaucratic hurdle here. And we have to approach it a different way. Ludmila, you rightly mentioned, we have to think about how to internalize cost. From an economic perspective, our free market economy or social market economy, whatever it is always based on price signals. And we have to make sure that these price signals can work and do the measurement what is needed that these price signals can work. And this is the only way to move ahead, because otherwise it's just a bureaucratic burden that we create. And so there must be a link between reporting and the price signals. And no one is at the moment thinking about that. And the governments have to start thinking differently. The billions that are at the moment pushed into the economies just to keep the old fossil-fueled economy alive. Imagine the billions that Germany and Austria are currently, according to a Gießkanne principle, pushing into the economy. And if we used just 50% of that money to stronger promote renewable energy,
absolutely,
we would have the infrastructure for the future ready. What are we doing? We are pushing it into the old economy as long as the governments have money. And they will be bankrupt in a few years' time. And then we will start to reshape the system.
Thank you very much. And I know we're a little bit over time. We also started 5 minutes late, so we're fine. So I want to end with one thing that the audience can take away from this panel. So if you can summarize in one sentence, what people here in this room can do to move towards impact, to integrate impact into their own investment approaches. What's something they can do?
How long should be the sentence?
Make it the longest German warm sentence that you want to.
Then another 1 hour and we will be done. I think the most important sentence or kind of concept to remember from this discussion, based on everything that has been said, is that if you act now, if you start thinking about sustainability in all of its different types and versions and ideas, you stand a chance to be a competitive player next year, in the next decade, in this economy. The economy, as it was explained really clearly, is going to look very different in the next decade. And if you don't act now, you're not going to be part of it.
Thank you. Bernd?
I would say don't follow trends in some way. Just look what is important to you. What do I want to do and change and go after that and do something. That's what I would summarize in a sentence.
Love that.
I would say invest in impact, but at all costs avoid greenwashing. So look very closely at what you invest in and don't make your organizations just follow fashionable trends and guidelines, but do it the real way.
Thank you. Last but not least, Alois.
One sentence. Follow common sense So Hausverstand, and listen to your own voice, your inner voice, and promote the inner voice, and combine the two.
Very strong last one to end with. Thank you very much for your attention, and come talk to all of us afterwards. Thanks also to all of you for contributing. It was an enjoyable and lovely session with lots of follow-up topics to continue with. But thank you very much, and Laura, over to you.
Yeah, thank you to our second really amazing panel, and I think we have all heard it. Impact will be soon, or is already, part of all of our investment decisions. And also the climate crisis is here, it's here already, and with it, it's investment opportunities. Just a short service announcement, because I got asked several times, the Wi-Fi password is ANDATS with capital A 2022 for everybody who needs Wi-Fi. And we're already getting ready for our fireside chat. And after the fireside chat, we have our third and last panel for the morning session. And after that, around 1, we will start with our lunch break. But now we're gonna talk about challenges when growing and also when exiting a startup. And I have the honor to welcome on stage Lisa Fassel, CEO of Female Founders, and Russell Berry, Managing Director of company. Welcome.
All right, so good to see you, good to be here on stage, good to see all of you. So for everyone who's standing in the back, there's some seats left in the front row and also in the second and third and so ever. So you can come join us. Russell, it's a huge pleasure. I mean, you've been chasing me yesterday and today to discuss this panel, and I have to say it's a huge honor to discuss a couple of topics with you. So I have to say that we're going to discuss different topics today. So we're also going to talk about impact, we're going to talk about regulatory aspects of investing, and we're also going to talk about the future and what it's going to be like in a difficult market as we see right now. But, and here comes the but, before we talk about the future, we should also talk at least briefly about the past to get to know you more. I think most of the people in the audience have heard about you, have been reading articles about you, have been wondering what the exact exit number was that you achieved with company. And maybe you want to clarify a couple of things and tell us more about who you are, what you've been doing, what you're doing right now, and what you're going to do in the future.
Great. Thank you very much. Thank you, everybody. It's really great to be here today to give a little insight of how do we get here, but more importantly, where we're going to go. My name is Russell Perry. I'm the founder and CEO of Company. Company is an Austrian regtech firm that was established in 2012 right here in Vienna. We chose the location not because of the regulatory necessarily framework and so forth, but because of a key ingredient that we needed as part of our business. So Company is a regtech company focused on KYB, KYC. I'm sure everybody in this audience knows about KYC, the burdens, but there's actually more opportunity. We, in the last, so established in 2012, we set up shop here, built a global company in the last 10 years with operations also across the globe, and are now about 75 people right here in Vienna. And this year, in February, we closed the transaction, and we're now part of the Moody Analytics family of companies and the KYC unit.
Well, so I already knew that you're an optimistic person because we're also talking about especially regulatory aspects in our previous conversation. But finding opportunities in KYC definitely means that you're the greatest optimist that I've met in the past years, for sure. So especially all the fund managers also know what it means like to go through a KYC process with a couple of banks. So now, more looking into the future, or actually looking at the current situation right now. So we see, and this has been part of the conversations that we've heard today, that the situation out there is wild. So no one knows what's going to happen. There's tons of uncertainty. Startups don't know what's going to happen. Investors are like, shall we start investing again? Shall we save our money? Shall we prepare for World War III? So everyone is like not sure what's going to happen and how to best act. And probably it's hard to actually say what's now the best way to do or the best thing to do, also looking from a company perspective. And it would be nice to dive into this, but I'm going to start with a rather simple question. What does all of this mean for the European tech ecosystem? Do you think that we're going to see the rise of European tech in the next couple of months? So do we see the opportunity here? Or is it going to be the fall of the European tech ecosystem as all the investors are pulling out the money?
Well, obviously I think about that a lot too, and I see also and engaging with startups, but also with investors, and that question comes up all the time. Where are we today, right? There's a lot of uncertainty in the market. There's external factors, there are geopolitical factors. The pandemic is not over yet. Which also has an impact. We have also seen a change, obviously a rapid change of how employees and how team members want to work, where they want to work, etc. But the uncertainty, and I mean, obviously I'm an optimist, but at the same time I do look at the different criteria and say, what's the realistic view today, but where do we want to go? That's the optimism. I think it's really an opportunity because always when there is chaos, always when there is also uncertainty, those that create some certainty also set the direction of the industry. So going back to your question, if we look at the European startup and ecosystem, right, I think there's enough cash and enough powder. So I'm hearing that from the different funds. Are there also enough investable startups, companies, or follow-ons? I think there is, right? I also think that because of the uncertainties, we have the opportunity to say, okay, let's focus on some key areas and really make some larger bets, rather than spreading the funds around into hundreds and hundreds of different areas. I think now is the opportunity also from the investor side to say, okay, we want to make bigger steps in this industry, right, or this sector, right? And I think also for startups, now is also the opportunity to say, I have a good idea, I have a great team, and I'm going to take this plunge. It would be a massive mistake, in my opinion, to say we're scared of the future. Yes, there's a lot of uncertainty. Talked about that. But if we're scared of the future, we might as well all go home right now. And I'm sure nobody wants to go home right now.
No, please don't. Totally get your point. So I'm wondering, now we're going to ask the audience a question, and this was not planned, but who of you would consider yourself an optimist? Okay? Half of the people, kind of half of the people. I think we're going to see more optimists by the end of our fireside chat, for sure. So you're mentioning that now it's the time to make bigger bets on some key industries. So I'm wondering, what are these key areas/industries from your perspective, also from an investment perspective, and from the perspective you at one point are maybe going to think about starting another company. So what, if you would start a company right now, what problem would you try to solve?
Well, those are two questions, right?
I know.
I think if we look at the sector, right, everything around education, everything about insurtech, fintech, regtech, also when it comes to specifically, I would even go back into biotech, right? I think technology, but with the mix of real applicability, is the litmus test, right? Can it be used today or tomorrow, right? And if you can check that, then I think you should make that bet. And if you look at the overall criteria, if I would say, okay, where would I invest today? It would be for sure something with an infrastructure component, with a service layer, right? What does that mean? Well, it's not specific. I know you would prefer to have one specific thing, but I see a lot of opportunities today. But the combination of a real foundation plus service layer addressing a real need, either in a broader market or even a specialist market. And I think entrepreneurs and sharing maybe some insights with the entrepreneurs and those that are thinking of what could I do, or is this the right time? If there's something specific that you see that major players in the market or the market has overlooked, focus on that one use case. You can always expand then in a second step.
That's always the easiest thing to do for entrepreneurs, right? Focusing.
I'm a bad example.
Thanks for being so honest about that. Same for me. I also can be honest about this. So now you've mentioned some key areas where I would definitely agree. And some of them are also connected to the topic that has been discussed on stage before, like this topic of sustainability, impact, and ESG. So I'm wondering, what's your perspective on this? Because one could argue, and the topic of our panel actually is funding growth, layoffs, repeat. So I'm wondering if what we are doing, and with the ecosystem that we've been building, are we sustainable, or have we been part of actually, well, destroying our planet, basically, by fostering this kind of growth?
Well, I think what's important, and every entrepreneur, but also every investment manager should always look at the aspect, does this project or does this investment also fit the social conscience that we should have, right? So obviously you want to have a framework where we can work where there's really free market, right? Because the market defines obviously, where the investment goes, business opportunity, etc. But the social conscience aspect, I think, is something that we need to, as founders, especially look at when we take action, right? When we take decisions, when we engage with investors. And this, the ESG aspect is obviously for the large funds, right? But it already starts at the level of those running companies and creating companies. And to answer your question more directly, yes, without that social conscience, which I think especially in some areas of the business community we've overlooked, right? It was cost, at any growth at any cost, no matter if it was just burning through money, okay, that's one thing, right, funds. But the other thing also, without the aspect, what does that mean as being part of a community? And also the obligations that we have as founders, as the managers of companies, our obligation to society, and that part obviously is the sustainability aspect from an ecological standpoint.
How can we foster this social conscious? And I love the term.
Well, the social conscious, I think it really already starts at the level in elementary school, in our primary and secondary education. I also believe that if we look at the different business schools and so forth, the social aspect is usually always very passive, right? It's not really part of the business or finance, etc. And I think that's where it starts. But we as a community need to also require or demand from those setting the academic curriculum to say it's not just a specialization one area. We have to take the social aspect to it, and at the same time, the free market economy with a social conscience is not contradictory at all. It makes business sense to ensure that your activities, your plan, and so forth have a social conscience component embedded.
Couldn't agree more. And now we're already moving into this discussion that is going into the direction of politics, which is, as I know, a topic that you're particularly interested in and also, let's call it, excited about. So this is why I would love to focus the last minutes of our discussion really on the aspects of politics, regulatory frameworks, etc. So what we see right now, as the markets are becoming more difficult, as there's a lot of uncertainty, as discussed, a lot of startups are like, okay, hey, we should get governmental support. We want the government to actively foster the startup ecosystem. And we also see the government, as it was just mentioned on the panel before, putting lots of money into different aspects of the economy and also of society. And someone called it the Gießkannenprinzip, that is very popular in Austria and also in other parts of Europe. I'm wondering, what's your perspective on this? Is this going to work? Is this pray and pray approach going to work? How can we actually make it better to ensure that we really see the rise of the tech ecosystem that we're also much looking forward to?
I would say a rise and expansion of the tech ecosystem, right, and all the components that go with it. So in the past few startups, we had a lot of support also by AVS, right? And I'm very thankful for the programs that were put in place. And previously, also with FFG, so and with also EU fund recently with a company on IDAS and identity services. So, but it's a very important component. So I don't want to criticize, but what I would like to share is that the bureaucracy tied to it and the speed does not reflect the need of those starting companies and the decision-making process, right? And I also think that, going back to some of the bigger bets, there's also a little broken link when it comes to the initial or the seed funding or support also by government programs, which is fantastic, absolutely, because it also gives some confidence from private investors to invest, right, in these new companies. But at the same time, there is no follow-on. Like any fund, right, from seed, not seed, but like pre-Series A, Series A, etc., will always reserve some additional powder or additional allocation going forward. if we can get the government programs to, on one hand, cut the bureaucracy, also look at certain areas where we want to invest, but also ensure follow-on funding, some criteria, then I think we can speed up the process also of the funding cycle if that component is ticked.
Now I'm going to give you the argument that we've received quite often in our political work, and that is typically Austrian from my perspective, but we've always been doing it exactly this, and it worked in the past years. So why should we change anything?
Well, I think that is always a historical view, but what's going to work tomorrow? And I think if we only rely on what has worked, it doesn't mean it's the most efficient or the most effective. We have to be a little bit more bold, also from an administration standpoint.
I couldn't agree more, but you're probably not surprised. The question is, how can we actually change this, and how can we convince the people who are making the decisions, who are building the bureaucracy, who are giving the funds, who are representing unions, etc. How can we convince them that the future is happening right now, and that the future is not something that is just, happening, but we can actually contribute to this, and we can actually really build the future and co-create it to create something that's better for everyone.
Yeah. So in my experience also working with a lot of government officials across the globe, also specifically in our sector, it's really about the communication. So the outreach takes time, but from my experience there, the reception is very, very high. But it has to be something that's not always a demand, but it has to start as a conversation. So I think we also have to not only finger point and say, oh, that doesn't work and that doesn't work, right? But we have to say, this is what the suggestions are. Of course, it doesn't help if the governments change, and we have a new government every 6 months in some countries, because we also need the consistency of the conversation. And it takes some time. But what I think is very, very important is that associations like AVCO and the Austrian Association of Business Angels, etc., that we are with our may say our 10-point list or something like that, that we engage even more, right? And we have to be consistent in that message. So it's not just about finger pointing, etc. But I think what we can say is we demand as a community, and as the 500,000 businesses in Austria, we demand not this Wirtschaftsstandort, right? This is, we tried to find the English name for it. It's the location of business.
Yeah, there isn't one.
Yeah. So the Wirtschaftsstandort, but it's not really about this single location. It's about ensuring a business framework, right, with all of the components from a taxation, from also the corporate law, et cetera, to make sure that we have a framework that's competitive internationally, and not just competitive, and I've mentioned this before, not just with Berlin, for example. Irrelevant to only focus on one player in the market. We really have to look at creating a business framework, legal, financial, tax, et cetera, that is competitive with the hubs, the tech hubs specifically in Singapore, on the West Coast in the United States, in the UK, and Paris, for example. And, obviously.
So I think we're going to get kicked off the stage in a couple of seconds. Is there one final thing that you want to say to the audience, or something that they should think about, share some best practice examples, something that they should take away?
Well, I think the most important thing is the uncertainty that we have today is the opportunity, right? So we have to be optimistic about it. Yes, there are factors that we cannot control in this audience today. But what I would like to share is a video, and I posted on my Twitter feed just recently, and I'm happy to share that also on LinkedIn, of what inspired me last year. I was at the Expo in the United Arab Emirates last year, and I was invited to listen to the program director of the UAE's Mars Hope program. Right? A very successful program, and a small country with only $200 million was able to send a probe to Mars successfully within 7 years. And this is where they also said, but what's the framework, right? And the framework was, we're not just doing one project, but we are also ensuring that we're going to have an academic program in our universities. We're going to expand the MINT programs in our secondary education, for example. We're going to make sure that this business framework, for part of their space industry, includes all of the components. And I think that's also what we should demand from those that administer our countries, that we need to look at this as from a perspective of business framework, so we can conduct business and create the value for the future.
Thank you so much, Russell. It's been a huge pleasure. One of the most enjoyable conversations that I was having on stage so far. Thank you so much. Please give a big round of applause to Russell.
Thank you.
Thank you, Lisa, and thank you, Russell, for sharing optimism in your analysis and also your straightforward opinion. We could listen to you for hours. But meanwhile, we need to take a step further in the financing life cycle. And we need to focus on the new approaches of growth phase, on new exit strategies. And for that, and for the third and last panel of the morning program, we'll welcome Chris Cesarian, who is Head of Intelligence at Sifted. Please, Chris, come on stage. We'll dialogue with Thomas Bobek, Managing Director of Erste Private Capital. Veronika Böhm, who is Head of Transactional Risk at Marsh. Oliver Holler, Managing Partner at Speed Invest. Karl Langmeier, Managing Director at AG Capital. And I think we're missing Sebastian. Oh, Sebastian, I didn't see you, sorry. Sebastian Eiseler, who is a GP and founder of Cadence Growth Capital. Chris, the floor is yours.
All right, thanks, Arno. You saved me the introductions, which is great. We're a little bit under time pressure. I appreciate we are the final thing between you and your lunch, so we are going to promise to keep to the allocated time. So we won't do any deeper introductions than what have already been said. The one thing I will note, though, is we have the full range of the kind of capital structure represented here, all the way from the earliest stage all the way to the largest kind of full-service bank. Just to set the scene a little bit, we're talking about the growth stage of investing. The sort of macro environment has come up a lot. And actually, before I go into that, I should probably say who I am very briefly. Sifted is a publication that writes about early stage and startups all across Europe. We span out of the Financial Times. And I run the intelligence team there. So it's my job to keep up to breast with trends and so on going on in the industry. So that's why I'm sat here. And in doing that day job that I have, the sort of macro themes that keep coming up at the moment are a really mixed bag, a sort of nice combination of tailwinds and headwinds for this part of the industry. The first tailwind is that there's a huge amount of dry powder in the early stages. I think some of the earlier panels commented that money needs to go somewhere, it needs to be deployed, and that will, of course, eventually feed through into the growth stage, which traditionally has been a bit lacking in Europe. There's sort of this growth financing gap that comes up a lot. So that's one of the structural challenges here. There's the global trend towards private markets, which is a huge benefit to this segment on the market. Companies staying private for longer and raising more money in doing so. And then, of course, there's the macro environment that we really don't need to go into. We all know what that is about as an additional challenge. So in that kind of mixed bag, complicated environment, it's a bit unclear actually how to succeed as a growth stage investor. And one of the things that came up in speaking to this group in advance of this call was that actually the first thing we always need to do is explain what is the growth stage. So we all agreed that it's something between VC and PE. But maybe to go into a bit more detail, Thomas, I'll ask you, since Erste Bank is across the spectrum, how would you define the growth stage?
Thank you very much, first of all. Thank you. Talking about the growth stage, what we observed over the recent years is what you already mentioned, that between venture capital and later stage buyout, leverage buyout segment, the growth equity evolved as a sub-asset class, I would say. And we, on our fund of fund side, particularly established in the portfolio construction a bucket to allocate to growth equity specifically. In terms of definition, of course, you are looking for top line, very strong top line growth opportunities, plus, and that's the important thing by definition of this segment, plus a clear path to profitability, a clear path of profit margins, profitability, as well as when it comes to the business model, proven product, proven market, of course, a good fit between product and addressable market.
Perfect, thank you. Now that we have the definition, I'd like to move to you, Veronica. In your role at Marsh, you see a lot of deals from a lot of different players. What's your experience of this year been so far? The public perception is very much foot off the gas. People waiting to see what happens, but what have you seen?
Thank you, Chris. So what we have seen is that there has not been a slowdown until recently, let's say in the last couple of weeks. So we have seen a lot of deals in Austria and also within the CE region. What we can tell from our experience this year is that there has been some sort of postponing, like auction processes over the summer into the autumn stage, and of course, you know, with the recent uncertainties on the market, this is to be seen.
If I may add here on this thing, we have made the observation in our target market that there are sort of 3 phases this year. First one was sort of the pre-war phase, where we've seen lots of COVID-inflated business models. The M&A world was still great. We've seen extremely high valuations, interest rates were low. And then the war came, the invasion of Russia and the Ukraine, and that totally changed the picture. And what we had seen is that sellers were still aiming to push through valuations at a very high level, and the world still has changed. So we were trying to sort of apply earn-out structures and the likes, and deals either took longer or they fell apart. So we've seen actually lots of processes, M&A processes collapsing in the second quarter and also like during the summer. And then the third phase, which we're on right now, where we've seen that sellers have tapped the market only after the break out of the war, and where they sort of adapted the valuation level to what the market is currently about. Similarly, they are also more open to earn-out structures in order to make a deal possible. And last but not least, you would not sell a business if you're not sort of resilient to some extent. So this is also the reason why we've seen more transaction taking place now.
Sebastian, does that mirror your experiences?
Yes, so I think in principle I can agree to most of what you said. I'm the founder and managing partner of Cadence Growth Capital, and we are exclusively focused on private equity growth, as we call it, in the German-speaking region. And what we see now is basically that sort of the impact of what we also saw in the public markets is kind of trickling down into our, let's call it mid-cap segment. You know, we are focused on companies that require 20 to 50 million of equity, and it's just an adjustment process. You know, that's what I would call it. At the beginning, there was a reluctance to reduce previously inflated valuations, and they tried to solve it with internal rounds or, you know, go broader into the market. But I think in most cases, the founders have also accepted that a down round is something to do now. So from that perspective, I can agree also to what you said. We still have a good deal flow. I think good companies will always survive and find capital, and maybe things take a little bit longer now. Maybe the valuations are lower now, but from our perspective, it's a very good time at the moment to invest.
Oliver, you're investing at the very earliest stages, and then the winners in your portfolio, of course, are going to feed through to this world eventually. Are you seeing them accepting the down round, like Sebastian claims, or is there still a stigma attached there?
Not yet. Well, first of all, most winners have raised tons of capital last year. So what I'm seeing at the moment is it's almost like a bit of a negative selection process going on. And now I'm specifically talking about growth rounds in venture. That's, again, to be differentiated from private equity. So this is the typical B round, 20, 25 million, 30 million, something like this, but still businesses that are growing very, very fast, are still burning money, but have proven business models, have proven markets, etc. So if you don't need to fundraise at the moment, you don't. So most really good companies don't go out at the moment because they don't have to. They try to control the burn, maybe create enough runway internally to get through the next 18 months. That's the direction we also give to all of our companies. And then there are the few unlucky ones that are actually having a great business but don't have the runway. And then there are a lot of companies that don't have neither. They don't have the runway and they don't have the proven business models. And that's the ones that are really, really at risk at the moment.
Thomas, what about you? Are you seeing this as well? High valuations, unwillingness to accept down rounds, the clear winners staying the winners, and then the rest sort of being left behind?
The overall picture is that the environment totally has changed this year. 10 years of very, very loose monetary policy and also fiscal policy created a flood of liquidity and an enormous tailwind for every kind of investment. And now everything is going back to normal. Rates are rising to, I would say, normal levels. So business should go back to normal levels as we know it in the long term. And of course, it will feed through valuations that will also adjust over time. And in the meantime, as markets and businesses do, there is some overreaction to it that creates opportunities. It may create opportunities when the moment of truth comes for the later rounds for those who are investing, and not so for those who are wanting to exit, but over time it will level out, I would say. So it's an adjustment phase we're going through, and there's not so much space for, or no space anymore, I would say, for doing mistakes, but it comes down to real investment, to cash flow oriented, as I said, clear path to cash flow streams and efficient operations. And the rest, what we have seen of exaggerations of the last years, it won't come back soon.
Are there any sectors that are particularly overvalued as a result of the, let's sort of the valuation hangover of the last few years?
I mean, we basically have seen an asset price inflation over 10 years in all sorts of asset classes. And clearly some sectors, you could quote technology in some highly scalable models that saw huge, previously unseen valuation levels. But if you have zero interest rates, you can make up every kind of reasonable investment multiple, because if it's zero, you can go pretty high. And as these base rates move, and they have moved, as I said, valuations will come to normality, and the further out the cash flows are, the more the impact is.
Has anyone in the group had to change their investment focus or their strategy as a result of this microenvironment?
Well, we obviously have a year of experience now. We've done our first closing end of last year, and I mean, what we have seen is, or where we would stay away from is any businesses which have supply chain issues, or now that we see utility prices rising, we would rather, stay away from that. So really go into the more resilient ones, which are again software services, IT services, B2B services, and healthcare sectors. So we've seen this one really thriving and being really resilient, even in a further downturn, which kind of almost everyone expects anyways. So yeah, this is what we are focusing on.
Given the uncertainty and the difficulty sometimes in pricing assets to do equity investments, are we seeing a shift towards different kind of instruments, that kind of thing? Veronica, do you see changes or any appetite for things beyond traditional equity raises in the market?
Well, we have seen some, but it is not so many that we can, say it is a firm change.
Not a firm trend yet. Anyone else?
Maybe one comment from our perspective on this. As you already mentioned, growth investing is not 100% defined, right? The venture guys have a different definition compared to the private equity guys, and we basically accompany good businesses from the development of a pure growth play into a growth but also profitability play, right? So when we do an investment case, the exit is always assumed to take place on a profitability-based multiple, and the entry, to the extent the business is not profitable yet, obviously you have to take some other multiples. And from that perspective, I would say that the developments that we have seen in the market now, where cash is becoming relatively more important again, and also profitability, I think has created a consciousness in the sector that you should value businesses also based upon profitability multiples. That's, I think, the change I see when people assess businesses.
And I hear people talking about this thing called EBITDA again, that went out of favor for a while.
What is that again?
EBIT.
Okay, yeah, exactly.
Yeah. One of the previous panels spoke about the move away from growth at all costs. I'm going to assume that we're all in agreement with that.
So again, I think this is not an either or. There is a very significant sector in the venture industry which is doing growth investing, and they are, all the US guys that are coming to Europe, they are doing Series B, Series Cs, late A's, and they don't look for profitability, just to be very, very clear. They look for massive growth, they look for profitable growth, and they look for sustainable proof points that this growth can be built out with further capital in a way that this company has a clear path to profitability, but they would not want to invest in profitable businesses. That's not what they're looking for. And there is a lot of capital coming to Europe into that asset class.
I think moving away from growth is not an option. Every crisis, you need to focus on your strategy, of course, and stay efficient and avoid big mistakes. But at the same time, you have problems because there is a crisis, and we have, if you currently look at it, we had a healthcare crisis, and we have an energy crisis, and we will have this for a long time. And there are also the supply chain issues which are not solved, which tells us that there are a lot of potential solutions out there and potential investments and potential growth stories exactly in these kind of areas. So it's moving away from the growth thinking is not an option.
We're honing in on why it's a bit hard to talk about the growth stage, because it's so varied and all-encompassing. But I'm getting the sense that there are a lot of things to be excited about, opportunities. Maybe we can do a round and just ask, where do you see the most opportunity in that sector?
The most opportunity, as Europe is the most influenced by the current crisis, there's also a lot of opportunity for Europe and our region. The whole supply chain issue, the whole dependencies on energy from one source, and the whole dependencies from production sites, and everything we buy currently comes out of China, Asia. The reindustrialization of Europe is not fantasy, it's actually happening. And that's not only an option, this is something that goes to kind of the core of our economy in Europe, and that's actually a big opportunity in multiple sectors.
Oliver?
I would call out climate tech. That's a huge momentum in at least what we see, and it's multiple aspects. First, obviously, there's really a demand from customers, from big corporates that need to get engaged, need to solve this for the operational business. There's massive dry powder in climate tech funds. I don't know how many. Every week there's a new climate tech fund. Actually, many of them focused on growth now, launching. And there's also tremendous amounts of entrepreneurial energy going into that sector. So there's a lot of things going on. And the other point I want to point out, the big opportunity for us is actually that the winners, there's a massive consolidation going to happen in the next 18 months. And the companies that have capital and that have a functioning business model will brutally consolidate their markets. That will not be fun for a lot of the smaller startups that will get consolidated. But for the ones that actually come out as a winner, that will be a massive opportunity.
Cool.
Yeah, I can't agree more. I don't know, who is in the room who's doing restructuring. I think you're going to be very busy in the next coming months and probably years. For all those who are not doing restructuring like us, I agree with what you said. I mean, we've now a period of 6 months since the breakout of the war, where we can sort of look at the current trading and see who is, adapting, who can flexibly adapt to the changing market environment, and who is most likely going to be resilient enough to survive. And these are the ones we are investing in. We're not one of these growth investors bringing in the really big bucks of money like we've seen in the US. Rather, we want to see as ultimate proof of the business model that the business is generating profits, and only for those we provide the growth equity. And here the sectors are similar, as I mentioned earlier. We love B2B services right now. We've seen some shortages in human resources, which we think we can overcome in the next months. But apart from that, they've been doing really well, even in the last 6 months.
Perfect. Veronica?
Well, from our experience sector-wise, I would say it is the renewable sector, and I think which is also what is in line, with all these aspects of the future, net zero carbon emissions, etc. So this would be from our perspective.
Yeah, maybe John, one last point from our perspective is that you mentioned the growth financing gap, which we have in Europe, particularly in the German-speaking region. And from our perspective, I think there is now an opportunity where we can start the discussion on more sensible valuations. And also, one of the differences between private equity growth and the venture capital segment is also kind of the value creation aspect that comes with the capital, i.e. the input that you as an investor have on the company, which comprises a bunch of topics which are usually not so relevant in the venture stage, for example, financing, for example, improvements of margins or working capital management. And I think this gives us now a good advantage, because those things are really important now if you want to accompany a founder to basically transition from a pure growth play to a balance between profitability and growth over the next 5 years.
We'll go into a little bit on the value creation piece at this stage. Let's narrow in a little bit on Austria, since all the signs above us say Austria. We've been talking about Europe and the stage as a whole. Do we see the growth financing sector in Austria maturing? Traditionally, it's a market that's been very reliant on bank financing in traditional forms. Are we seeing a greater degree of sophisticated players, vehicles, products, that sort of thing emerging? Maybe, Veronica, you're best placed to take the initial view.
Well, I think yes, because in the last 6 years there has been also from the advisory end, a lot of experience, especially in the venture capital sector, and also you need, specialists who understand your business, who can provide a certain added value to go ahead, yeah.
And what excites the group most about the growth stage in Austria? Do we see particular potential in Austria as a market?
It's an empty space.
Empty space, room to play?
A lot of room to play.
Yeah?
Lots of really interesting small and medium-sized enterprises with a younger generation of entrepreneurs, more willing and less hesitant to take on VC and private equity money. And obviously, it has been very beneficial for the region and the country that there's a lot of activity in the VC space. So that has been also beneficial for new players coming in and the banks coming back to the asset class.
Yeah, maybe from the banking background, that the bank financing of companies in Austria has a huge tradition and actually is a very strong and solid pillar of financing Austrian companies and entrepreneurs and successful businesses. And that it's proven and a success story as such. What is missing is the other part, the equity side of the story, and we more and more dealing in an international space. So it's if you talk about growth, more money, more capital is needed, and it can't only come from the bank financing side. You need these equities to support the solutions, these opportunities that arise, and the new business models, the transformation of the business models. It's actually really needing, and the gap is really there, which means opportunity.
Yeah, I would say, I mean, when we started 10 years ago as a seed VC in Austria, it was like lonely. And it was really a lot of education to be done. And I think now, 10 years later, I would feel that like seed is already, we're there. So there's a lot of other players. It feels like a healthy environment. The growth stage now it's a huge opportunity, and there are players now emerging that come out with new energy and with new approaches. So I think there's a massive business opportunity to go into that area. And we have a very, very different entrepreneurial infrastructure, so to say. We have scale-ups where new teams spin out and create something big with big ambition and different level of sophistication and experience. And so we are very bullish on Austria, actually.
I think you're the only non-Austrian sat here, Sebastian. So are you as bullish on Austria?
Yes, I think
you don't have to be polite.
In all fairness, at the moment, Austrian deals make up probably less than 10% of our deal flow, which I guess is also representative of the German-speaking region in terms of population. We have a couple of Austrian people in our team, and obviously it's a market where we want to get more entrenched. We have a couple of discussions going on, but I agree that Austria is a great country for good companies, and the term Wirtschaftsstandort was mentioned, and I think it's very competitive with the other German-speaking countries, Switzerland and Germany.
All of the two of them. Is that maybe perhaps a little bit of the challenge for Austria? Is sort of as a country perhaps too small to stand alone within its regional framing? DACH, it's the smallest market. Within CEE, well, it's a very complicated, fragmented kind of landscape. Does Austria sometimes fall between the cracks?
Probably, I would say so. I mean, Switzerland is not much bigger, but Switzerland, for whatever reason, has attracted a lot of really smart and successful entrepreneurs. So there, we seem to see more companies relative to the size of the country. And I don't know what can be changed, but I think it's probably correct what you say. It's a little bit underrated, a little bit under the radar.
But under the radar sort of suggests hidden gems, opportunity, that sort of thing, or is that the Austrian in me being a bit optimistic?
Well, you said I shouldn't be polite. I wouldn't call it hidden gems, I'm not sure. Maybe they are gems, but they're not that hidden, So we see a couple of really high-profile Austrian companies, but those are visible, It's probably in the smaller segment where people don't put a lot of attention because the country is relatively small. I think my Austrian colleagues should comment on that as well.
Carl, you're shaking your head.
As I just said, I see it's huge potential. It's blue ocean strategy. It's almost no one there. And I remember the days where Austria had a very lively, also growth equity buyout scene with a dozen or more private equity players. And now, in fact, we are the only independent later stage private equity firm. And this is why we say we would love to see more. Also, from an educational point of view, going out and educating the companies that they have a variety and they can choose a partner. So I think this would definitely help to create an even more lively space, similar as you guys have shown it in the early stage.
What happened? Where did they all go?
Well, that again, the reason, and you might be able to say something, Thomas, to that. My reading of it is the private equity scene in Austria has traditionally been bank financed to, I think, 2/3. And after Lehman, everyone pulled out, and that led to this shakeout. Even the state to create their own funds and try to support this. But again, now it's changed. We have a very lively early stage scene, and this is also the main ingredient for a more lively growth equity and buyout scene.
Okay, let's do one more piece on Austria, and then we'll move.
To add, there's the financial crisis maybe wiped out some parts of it, and the associated regulation with it. So taking on risk on a balance sheet got much harder and almost impossible for a while. However, as we heard today already, we as a bank strongly support private equity initiatives throughout our region, and also if we talk to our investors, especially institutional investors, they really established a strategy for private markets, private equity in all segments right now. That was not the case in the years 2000, 2008 and beyond, but over the recent years, we see private markets being established as an institutional asset class. We see insurance companies, pension funds setting up their structures, setting up their programs to invest, and that is done and made to stay as investors and to invest through the cycle. That tells us that the asset class is here to stay now, and it's maybe this time is different. That's a tough word, but we see the structure being established, and it won't go away.
I definitely get the feeling that Austria is punching above its weight in terms of activity as a relatively small country, but then maybe I'm biased. I don't know. One thing that came up was access to the SME, or perhaps better phrased, the Mittelstand, the sort of famous backbone of the economy, with a perhaps historic reluctance to engage with financial parties. Is anyone seeing that change? Is that a big opportunity for the growth stage?
Absolutely. Like I said earlier, I mean, this is where we get all the great influence from the early stage sector, because we're now seeing increasing number of a younger generation coming into force, either because they started up their companies themselves and brought it up to sort of a SME with revenues, I don't know, above 10 million or more, but also that they inherited the business, took it over as a successor or something, and we see that they are now less hesitant in taking on partners in order to boost growth, in order to play the consolidation game, in order to be more stronger, emerge stronger out of the crisis.
Anyone else?
Yeah, I think in that way, Austria is quite similar to Germany. You know, there's the Mittelstand, and also in Germany, Mittelstand has been a little bit reluctant to open itself up towards private equity. And if you look at the private equity penetration in general, you know, as a measure relative to GDP, for example, Austria also is similar to Germany. And I think over time, we will see this changing. I would make one additional point, though, which kind of acts to this argument. What we also see is that the younger generation basically forms new companies, which then disrupts the incumbents, which we call Mittelstand. So I think the Mittelstand, you know, has also to cope with this challenge. And obviously for investors, you know, both strategies make sense, invest in the Mittelstand, but also invest in the disruptors. But I think both aspects are very relevant these days.
Anecdotally, is that something you see, Oliver? Lots of founders perhaps not taking over the family businesses and doing their own thing, or is that not something you've observed?
Yeah, I mean, that's a phenomenon, I think, overall in the startup ecosystem, that a lot of the founders actually come from pretty privileged backgrounds. So there's a lot of repeat going on there. It's a fact. And then a lot of them actually are going into different sectors than where the families are typically operating in this. So they don't necessarily challenge their own parents, so to say. But it is very, very visible, yes.
It's perhaps a topic for a whole nother panel. Okay, we've only got 10 minutes left, and we will open up to some questions from the audience, so you can start preparing those if you have any. We've done a bit of a well-worn tour of the growth stage conceptually, its unique challenges. We've honed in on Austria, its position within Europe. Let's talk a little bit about how to be a successful growth investor. You know, how can you navigate all of those things? What is the way to succeed in this segment without talking up your own book too much? We'll start this way and we'll go around.
So again, I think it depends also a little bit, again, which strategy of growth investing you pursue. We come from the private equity world, so from our perspective, one of the biggest risks we take in scaling companies which have a proven business model is the execution. And obviously, you can never get everything right as an investor. And therefore, I think it makes sense to, avoid the losers, so put a lot of focus on the teams, put a lot of focus on assessing the business models and the inherent profitability in a business model. And secondly, try to invest with a structure that also makes you money if things don't go as expected. And actually, that's probably more often the case than not. And I think this is something which is particularly relevant in the growth stage, where you basically invest in companies that are about to turn profitable.
Well, I would say to get the correct risk partner, like certain Marsh or other insurance service providers.
Can't agree more. We've worked with you before. Now, I'd also say it's of utmost importance to do your homework diligently and really focus on the companies you want to invest in. Maybe a second thing would be to provide the flexibility to provide tailor-made solutions to every deal that goes in the right direction, what you just said. And last but not least, also be prepared to walk away from a deal, even though you've spent a lot of time on it. But if things materially turn out differently from what you expected or were told, simply walk away from the deal.
Well, so I'm again now speaking about the growth venture side. And I would say there it's exactly the opposite. It is not about optimizing for the downside. You need actually, everybody knows venture is driven by the power law. A few deals make the difference. It doesn't matter if you get 1x or half x or 1.5x from the losers. So you need to be in these deals. And that means you need to be either earlier or have a better brand or have a very specific value proposition. So if you're just an undifferentiated pool of capital that is swimming with the crowd, you're not going to get in these deals, or you get in these deals at valuations that are just too expensive. So that's the job.
Maybe I said it before, it's the general topic is allocate your capital wisely. As there is more headwind to expect, there is less room for errors, and as capital is more scarce, and there is the need to engage more with the portfolio companies. There is more focus on the core strategy on the fund level, but also more focus on the core strategy of the portfolio companies. As I said, more engagement, closer KPIs, more multi-stage investing when companies meet their KPIs, being also patient as private capital is patient capital, but resists to the pressure of investors to deploy capital quickly. So there is some room, and there's, as I said, opportunities as well. And to end on a high note, it's maybe some headwinds, or for sure some headwinds ahead of us. When everybody worries, you should worry less.
That's very philosophical. Okay, to try and summarize on how to succeed in growth, what we've heard. Do your homework, focus on your core strategy, do as much value creation as you can, that one sounds obvious, and then differentiate. Let's just dig a little bit into differentiation before we open up to questions. What does that really mean here? How can you differentiate as a growth stage investor?
So I think, there are a couple of elements. First of all, I would say that you really need to differentiate yourself because capital is available in abundance. And even though the interest rates are increasing, I suspect that looking at the dry powder charts, this will remain. So you basically have to position yourself as the preferred partner. I think this is the same in both of our segments. And the question is, how do you do that? I mean, first of all, the whole aspect of actually personal interaction is quite important. And a founder who has built a business and wants to bring it to the next stage will very carefully consider with which people he enters into this partnership to basically help him go to that level. So the personal side of things is, I think, very important. And the second aspect is, I think, the value creation side. So basically, you have to prove to the founders you're working with that you can help him in aspects to develop the business which he doesn't himself know or has the capabilities within his business. You know, this could be optimizing the financing structure. You know, this could be support in helping to scale the organization. This could be establishing new contacts to potential customers. You know, this could be support in M&A when we are talking about a buy and build strategy, and that's basically, I think, how you win a founder. And those are, I think, the two biggest important points from our perspective.
Yeah, we consider ourselves as a later stage investor doing traditional buyout money for SMEs. And what really sets us apart from the American growth equity investors Oliver was mentioning earlier is that we really do only invest into profitable business models. So this is something we want to see, and that's what sets us apart, number one. Number two, similar to what you said, we consider ourselves being a value-added investor. So whenever we look at a deal situation, it's really that we ask ourselves, what is the benefit we can bring to this business? What is the network we can bring in? And can we have take this to the next level, this business to the next level within the next 6 to 12 months, just simply because of our network and our know-how, obviously, we have in the team or in our wider network.
Okay, Oliver?
Well, in growth venture, it's very simple. Either you go big or you focus. Either that. And all the US guys, multi-stage guys, they go big. They provide unlimited access to capital, basically. Everybody else has to focus.
Go big or focus. I like that. Catchy. Okay, let's try and do questions from the audience. Any questions on this wide range of topics that we've covered under the growth stage? It's a bit hard to see you all because the lights are quite bright. No? This is the most shy audience I've ever seen. Have we wrapped it all up? That's it? Everyone knows what to do now? How to be a good growth investor? Well, that's probably testament to all of you having done a great job. Well done. Any final remarks from anyone?
Mahlzeit.
Everyone's hungry. Everyone wants to go for lunch. Yeah, Mahlzeit. Okay, well, on that note, we won't keep you from your food. I hope you enjoy. Thanks for listening and enjoy your lunch.
Thank you.
Thank you.
Thank you.
Thanks, everyone.
So,
yeah, thanks to our last.
You have. Yeah? Muss mal weg.
Yeah, thank you very much.
Yeah, thank you so much to listen to our morning sessions. Now we're going to head into. Okay. Yeah, thank you for listening to our last morning panel, and also thanks to the panelists for sharing the insights. As most of you already know, we're having the lunch break now, and we will start with the 3 sessions afterwards again at 2.
Yes, so enjoy the lunch break. We reconvene at 2 p.m. and you will have the choice between 3 different rooms and 3 different streams: later stage, early stage, and workshops. Up to you to choose the one who is the most suitable to you. So bon appétit and happy networking, Father.
Yeah, and also bye to our live stream guests. Thanks for joining us also online.
Many people think that they need millions to start investing in private equity. Well, that's no longer true. With Moonfair, you can invest in top-tier private equity funds with surprisingly low minimums. So how does it actually work? We pool commitments from multiple investors into feeder funds, which invest directly into underlying funds. By doing so, you get to invest in funds normally reserved for the select few. Create your free Moonfare account and view our funds today.